divided by 12, base salary. Put that down. He averaged 6 hours per week. So they're telling us he averages, so we're going to assume it's for 2 years. And he receives double pay based on $25 an hour. So $50 an hour times 6 hours a week. Yet he gets 4 weeks of paid vacation. Do we get, that's right, Jordan, we only get 48 hours of overtime, 48 weeks of overtime. So we're going to take his 6 hours times 50 an hour, $300 a week, times 48 weeks. We don't get paid overtime when we're on paid vacation. So times 48 weeks, because it says he gets 4 weeks paid, so that leaves 48 from 52, right? And that added all together, but the glasses are off. All right, but yeah, so that makes 55.33, right? The caveat there was don't use overtime times 52. They specifically say something of paid vacation. We don't get overtime. So that's a little trick that was there. So 14, appraisals that use the sales comparative approach do what? What do? We use 3 similar recently sold properties. Number 14 is A, right? We're comparing my house, the subject property, to 3 other recent sales, line by line by line. How does our house compare to those houses? And we compare what it sold for. Okay, back to appraisals. My maximum net adjustment per comp, each singular line, net is the small number, gross is the big number. So 15 is C, 25 net. It's 15 net, excuse me. C is 15 net. Net's the small number, 25 overall, cumulative 15 gross, but 25 per line, or 15 per line. I don't know why I keep saying that. C, not A. If it said gross, A is the answer. If it's net, B or C is the answer. The answer is C. All right? So just a few. All right, Reggie, date of birth. Date of birth. A HELOC. A borrower's getting refinanced. What's my LTV, CLTV, and HLTV here, right? What do I owe on the first, LTV? What do I owe on the first and second combined, CLTV? What I owe my first plus my line of credit? That is C, 70, 81, and 90. Awesome, right? Didn't see any mistakes there. Awesome. First. Number 17, values 295, CLTV of 77. The second is 10. What's the amount of my first? Well, 77 at CLTV minus 10 equals 67. So 295 times 0.67, just reduce those down, equals D, 197,650. 197 D. And we're all getting hundreds? Anybody miss one? You're doing great. Awesome. Missed one. All right. Do we understand what we missed? Like, oh yeah, remember, read the question carefully and thoroughly and make sure we know what we're looking for. Sometimes I just like to look at a question. There's so much there. It's like, all right, let's just slow down. What are they asking here? Sometimes there's going to be so much information that you don't even need in the question based on what we're looking for. All right. Next one. 21, 23, 25, 29, 31. 21. What happened there? 23, 25, 29, and 31. H is the high or the HELOC LTV. We went through that a couple times, Robert. It's what the value, what instead of adding what they owe on their HELOC, in this case they owed 25,850. We add the limit, not what they owe, but what they could owe if they max it out. So it's the loan, the first plus the maximum line amount on the second, not what they owe, but what they could owe. Yeah, we went through that a couple times in LTV yesterday. Okay, got it? Got it. I didn't start my timer. We'll figure it out. Update. No. I don't have an answer to that question, Eric. I'm not exactly sure what you're questioning, sir. Oh. All right, we're doing 21, 23, 25, 29, and 31, right? You see that in the yellow and the green? What are those? The questions we're doing, the review test on yesterday's loan origination activities. All right, 21, mortgage insurance premium, MIP. What about it? That's right, D. MIP is paid on D, any FHA loans. Actually, all FHA loans have MIP, not PMI, MIP. Title insurance is required on every loan by whom? The lender. C, the lender, on every time there's a loan, the lender requires title insurance. C. 25. For a QM, what's my maximum air quote debt ratio, right? It's not firm yet. It will be in 2021, or will it? But it's D. It's C. 43. 43. Yep. 29. The VA covers up to what of the veteran's entitlements. All right. There's two things. We get an entitlement. There's an entitlement, and there's a guarantee. The answer D is we get 4 times. They can borrow 4 times of their entitlement. They guarantee up to 25% on a normal loan, but the entitlement determines loan amount, and that's the 4 times. We went through that a little bit. Reread that entitlement. It's kind of confusing, but if my entitlement's $36,000, my maximum VA loan was $144. Now we give bonus entitlement all the way up to whatever it takes to get to the Freddie Mac conforming loan limit. And then when we make the loan based on their entitlement, then the VA is going to give us a guarantee based on the loan amount, but a normal loan over 144 is 25%. So the 25%, some of you answered, is how much they guarantee their loan amount. Their entitlement determines how much they will guarantee. Entitlement, 4 times their entitlement. Okay? Okay. 31, in which of the following instances would we have to have flood insurance? You get flood insurance when? When you're C in a flood zone. Flood insurance in a flood zone. All right. 32. Everybody get 100 there? Not on the 23rd floor. Exactly, Mr. Kearney. Okay. 32, 34, 36, 39, and 40. Right back at you, Charles. Who's my moderator today? Say hi. Tell me who's hanging out with me. Hi, Alec. Alec, when we do the quizzes, if you would please always post the answers at the end of each stanza. Okay? Sometimes people miss them and they can go back and find them. Thank you. Oh, start. What's going on with my timer? Well, I wish they'd tell us that. I don't understand that. They have the answers on a sheet. All right. Thanks. He was posting them yesterday when he was my moderator. Be right back. More coffee. All right. 32. Why would we analyze a credit capacity? Capacity helps us determine if they're what? Capable. Root word. D. Capable. How have they handled the credit? How much credit do they have? Does it look like they can handle more? How have they handled what they've got? What is their capacity for dealing with debt? D. All right, 34. A couple has a loan of 245.6. Their fee is going to be 2 points. 2% of the loan amount is B, 49.12. Loan amount always points or percentages of the loan amount. Where a borrower's got a property in a flood zone, who's going to underwrite the flood insurance behind it? It's going to be FEMA's B, Flood Insurance Program. National Flood Insurance Program. That is correct. 39. We're refinancing a house. We've got a HELOC. What's going on here? Which statement is correct? This is one that some people get a little confused with, and they get frustrated. Right. Right. So far, I haven't seen a wrong answer. Anybody else? There we go. No, not A. All right. All right. So the answer is C. Right. Every answer has to do with LTV. A, the LTV is 100. B, the LTV will require mortgage insurance. It says we have mortgage insurance over 80. C, the lender will not require mortgage insurance, which means our LTV would be under 80. And D, the LTV is 90. What's my definition of LTV? What's my balance of my first compared to my second? So A, the house is worth, this is how, when people get a lot of information, they seem to get a little overstimulated sometimes and just make a guess. Well, let's make an educated guess. All right, the property worth 221, and the new mortgage is going to be 175. All right, so is the LTV 100%? Do I owe 221 on my first mortgage? 100%. My first is the same as my value. No, not A. The lender will not. So every answer has to do with what? LTV. So they give you all this information, and all we're looking for at the end of the day is what's the loan to value. So when you start reading the questions, don't like, I don't know, I'm just going to guess A. Well, A, the LTV is 100%. We know that's not right. All right, so process of elimination, and again, backing away and saying, what are they looking for here? The LTV, 175 divided by 221, gives us the determination that C, it's under 80%. It's 80% or less, which means C will not require mortgage insurance, okay? All right, and 40, for determining whether a borrower has income and assets to afford a mortgage, we can never count what? We have eliminated the ability to look at equity-based lending, so C, the fact they have a lot of equity doesn't mean that they can pay their mortgage. It means we can foreclose on them. We can't do that. We can't set people up for foreclosure, so no lending based on equity. It's income, it's credit, it's assets, it's all the other features of ATR, right? C. Awesome. All right. Let's do one more set. Let's go 24, 37, 42, 43, and 45. All right. 24, 37, 42, 43, and 45. Yeah, he said they're told not to do that anymore. I'll find out why. Now 36 is B. B. All right, good job, Arania. Oh, I forgot to turn it back on when I went to refill my coffee. Sorry about that. Yeah. All right, so 24. The DTI for a standard FHA and a VA is what? And the answer is D. And if you can't remember the FHA, remember VA is the only loan that makes you qualify on one total ratio, 41%. So the only answer for VA there is 41, so we could have deduced it with that, right? 24. 30. Did I say 30? 24, 37 is one of the following does a lender use to analyze a borrower's financial capacity? That is our D, our DTI, D. All right, 42. In which of the following transactions would we give a borrower your home loan toolkit booklet? Those are required only when it is a purchase. Only on a purchase. Only on a purchase. All right, number 43. I don't know, Jordan. Number 43. The disadvantage of holding interest in a leasehold instead of fee simple is what? Which one of these would be a leasehold? It's going to expire at some time, and you're not going to have the property forever and ever. So D, you do not have the unconditional power to pass it along to your heirs. It could be on a 50-year lease or a 99-year lease. At some point, it's going to end. So D. And 45, the first is 90, the second, the CLTV is 90, the first is 78. How much is my second mortgage? Well, 90 minus 78 is 12, so 12% of 495 is C, 59.4. 59.4. All right, how's that? How's that? How are we doing there? All right. All right. 43 was D. 43 is D. Yeah, leasehold. Leasehold, you're getting a house on a 50-year leasehold. At the end of 50 years, it could expire and go back to the owner of the land. You can't have unconditional power to pass it on to your great-great-great-great-grandkids because it's going to expire at some point. All right, Jordan? All right. All right. Well, that's loan origination activities. Now we're going to start the fourth module of the 20-hour course, which is ethics. Ethics. All right. We're going to go to ethics. And the main thing we're going to start with is the ethical treatment of our industry. We're going to start with ethical issues related to federal lending laws. We're going to have a little review of a couple of the laws and the ethics behind some of the laws. The first thing we're going to talk about are RESPA violations of ethics, TILA, high-cost loans, the GLB, privacy stuff, ECOA, and we're going to touch on Fair Housing Act today. We're going to go through fairness in lending. We're going to talk about all the new appraisal and independence rule. We're going to spend some time talking about different types of fraud and how to detect fraud, violations that are common in advertising, and also predatory lending and steering, plus our relationship with all the other aspects of our industry. All right, so let's start with a polling question. For one, how familiar are we with the ethical issues facing our industry today? Are you well versed? Some general, or what's ethics? Right? All right. Oops, stop that, reset that, turn that off, make sure my ringer's not on. I think it is off, usually is. All right. So, the poll says 84% voted, and we're at 24 well-versed, 43 some general, 22 vaguely familiar, and 11 people like, I don't know, right from wrong. I'm kidding. All right. So what's the ethics behind RESPA? What are the concerns with RESPA? RESPA's main concern on the ethics side is the ability for mortgage professionals and any other settlement service provider to pocket fees that we have not actually earned, right? No referrals, no kickbacks, no splits, nothing. If you don't earn it, you can't get paid from another provider, right? It says mortgage professionals to pocket fees. Well, if you're going to be out there focused on purchase money business, typically, I've been asked to pay for a lot of things in my life. I have never asked anybody to pay anything to me or for me, right? So we've got to be careful, not only like if we're going to be doing a bunch of refis and we control the deal and I want to make money from the escrow and the title and the homeowner's insurance agent, because he who owns the lead kind of owns the deal as far as recommending this and that. If it's a purchase, typically the real estate agents, even the seller's real estate agents, directs who the title company is going to be. So sometimes we don't direct it, but other times people will say, "Yeah, man, I'll give you some business, but I want you to pay for this for me. I want you to pay for my advertising. I want you to help me with this, help me with that." And there's some legal ways to do things. Joint advertising. We want to run an ad together in the local Homes and Land magazine with Betty from Beachside Realty and Skippy from Skippy's Mortgage, and they put a joint ad together. I'm advertising. They should split it, but a lot of times agents think you should pay for it. We got to pay attention to those RESPA violations, what's legal and what's not. So violation of RESPA, Regulation X, occur anytime any unearned fee or thing of value is given between settlement service providers, and they didn't do any actual work to earn the fee, right? Our TOW. T-O-W. Is there T, a thing of value? That is O, being offered, and then was it accepted, right? If I offer a realtor kickback, that's a violation of RESPA. If the realtor accepts it, then they're in violation. If they don't accept it, then they're not in violation, but I'm still in violation for offering it, and the W, of course, is work. Was there any work done to earn that thing of value? Did I do some work for the title company to get that fee? Chances are no. So therefore, violation of RESPA. Right? Violation of RESPA. Let's talk about what's not a violation of RESPA. That comes up. If we're doing promotional material or we're doing things that we're passing out swag, stuff we all get. I live here in Denver. There's a football team here. Did you guys hear about the Broncos? They won the Super Bowl. It's a pretty big deal. They sold out every game in the entire history of the Denver Broncos as an NFL franchise. So tickets are at a premium. But so are just the Broncos. So if I wanted to print out some really cool Broncos schedules with my company name and logo, and I went and passed those around, that's not a thing of value being given for a referral or it's promotional material. All right, so pitch, calendars, pens, promotional material stuff, not violation of RESPA. Buying something, Broncos tickets for a realtor, would be a violation. Passing out flyers, going around to open houses saying, hey, I got some flyers for anybody that comes in, based on your sales price and 5 or 10% down. Here's some different options of what this house might cost them today with some with financing in today's market. Well, that's not anything of value. I mean, it might be valuable to help promote something, but it's not. There's no numeric value to it. It's right. It's not lunch. It's not tickets. It's not sporting events. So promotional value, swag, stuff we all get, stuff we give away for promotional, not a violation of RESPA. I could even buy lunch for an entire real estate office if I wanted to provide it for everyone. The condition of them using me is not part of the deal. Like last year when we were doing the changes were coming down for TRID. All right. Well, I'm a good originator. I want all my real estate agents. I want them to know I'm an expert and I know what's going on. So I'm going to put a symposium on for all the real estate agents in this office, anybody that wants to come, and tell them about the changes that are coming down that's going to affect all of us with the new TRID laws. And when I do that, I'm going to bring in some pizzas and sodas and stuff. All right. That's a general educational. Everybody's welcome to come. Not for just people that use me, etc. Yes, I'm promoting myself, but there's a lot of things we can do to advertise and promote ourselves. It's not an individual thing of value. All right. So those are what's not a violation of RESPA. Everything else, yeah, you can't single it out. That's a good way to put it, right? If I specifically buy this real estate agent lunch and try to tell them why they should use me and all the great things that I do and my company does, it's still promotional, but I'm giving them something of value. I'm picking up the check. We should technically go Dutch on that lunch. Now, people ask me all the time, well, I become friends with my agents and people I used to do business with. I can't buy lunch for my friend? Not if they're referring you business, you can't. But the way I like to look at that is, it's a beautiful sunny day in Denver, Colorado, as usual. And I-25 is just a little bit over here, and I'm flying down I-25 headed to Wyoming today. Speed limit's posted 75 miles an hour. I'm driving 78. I'm in the middle lane doing 78 miles an hour, and my lights work, and my brake lights work, and my registration's in order. Right? My first question is, am I breaking the law? Am I speeding, doing 78 and a 75 on the freeway, not tailgating, with no traffic around? Right? I may not be worried about getting a ticket if I pass by a highway patrol officer, but I technically could get one because I technically am speeding. So even if it's a small little amount, the chances are you getting a ticket for doing 78 and a 75 in a wide open freeway is pretty slim. But it's still breaking the law. So that's the answer when you've got these little questions about what can I do in RESPA, all right? Is it a thing of value? A $10 Starbucks gift card is a thing of value, all right? It's no big deal, but it is driving 76 and a 75. You're breaking the law, all right? That's the rule that you need to live by. ABA, disclosure, what are they? Right, if you have referring them to anybody you have an affiliated business arrangement with, we must give them an affiliated business arrangement at the time of referral. I did not know that, Alicia. First NFL player to have $1 million contract, Alicia said, little known fact, it was John Elway. I haven't lived in Denver, Colorado for just about 10 years, but I've always been a Broncos fan since the Elway days. So I've got to meet John, and he's doing okay at putting a Super Bowl team together as well. Yep. All right. Well, thanks for the fun fact. All right. So affiliated business statements are mandatory. So at the end, right above that on 320, Regulation X permits normal promotional education activities that are not conditional on the referral of business and do not involve a defraying of expenses. Everything I just kind of explained, there's the way it's worded in the statutes. Pens, notepad, etc. All right. Now what's affiliate business arrangement? Let's talk about the sham. We brought this up on Monday. I said we'll talk about that more on Wednesday. Well, guess what? Here we are on Wednesday. All right, so at the top, disclosure of the relationship, right, with an ABA. We're not required to use the referred entity. When can I make a borrower use an ABA? What are the conditions, if any, when the borrower can be forced to use my affiliated business partner? Who can tell me that? Please, somebody, maybe more than one. Who can I make them use, even if it's an affiliated business arrangement? Appraisals is one. Good job, Robert. ACA, there you go, Rachel. ACA, appraiser, credit bureau, and in lender attorney states, the attorney. Those are the three that we can mandate who they use, even if it's an ABA. We mandate it anyways, and even if we have our own appraisal firm, we can. Borrowers never get chopped for their appraisals or credit. Doesn't matter what the scenario is. They do not get to choose those items, and they do not get to choose. I've never worked in an attorney state, and all attorney states aren't the same. But say lender attorney is going to do this, this, and that. The lender chooses the attorney. That's what we get. So when we have an ABA, we have to disclose the relationship. We can't make them use that party unless it's ACA, and no thing of value except for a return on ownership, right? If I've got a 20% stake in this escrow company, I lived in California a long time. A lot of you won't use escrows. You'll use closing agents. If I've got a 20% in the closing agent that we're using, I can make 20% of the profitability, not how many transactions we sent. I can't give my originators more money because they're using they work for me. I own the mortgage company. They don't have a 10% interest in the title company or the escrow company, so the originators have to disclose it because the company has it, but they don't get paid on that. All right, no return, only get paid a return on ownership, not per deal, not based on how much business we gave them, anything like that. All right, so the factors that the CFPB inherited from HUD when they take a look at these little shell made-up companies is: are you really a standalone ABA? Do you, A, have sufficient capital to operate your own business, your own enterprise? Do you, B, have your own employees that work just for that enterprise? Do you control your own business affairs, or do the owner, do me and my partners control what you can and can't do and how you work just for us, right? Do you have a separate office location? Do you assume the risk and rewards of a comparable enterprise? Somebody else doing what you're doing? Are you same risk, same rewards? Do you perform its own work instead of contracting it out to an independent contractor? 6 and 7 are very similar, right? Proof that you pay a reasonable amount based on what you do. You compete in the market for business other than the hand-me-down business. And do you have interaction with other people in the industry other than the lender or the real estate firm or whomever that owns you or has an interest in you, right? If you're just doing, that's the ABA sham thought process. And if you're sham, each owner must have an investment of its own capital. Each owner's interest is based on that amount invested. Like I said, you can only get return of investment. So there's a title company in Michigan about 2 or 3 years ago I read about. They came in and it's like they had 90 ABAs. They went out and had close to 100 ABAs with different real estate firms and different mortgage companies. And everyone had a different name, and they all had a phone number and a business card, and that was about the extent of it. Oh, here, just say we're going to set up our own separate independent title company so you can get paid on the referrals on the title business. But it was not. It was a sham. It was a shell company, etc. And didn't meet hardly any of the criteria to be a standalone ABA. So each entity that had one got fined, and the title company itself was like huge, massive fines. Yeah. Yeah, it's even if it's obvious, Nancy, as a State Farm agent, I do a lot with you guys. I do a lot of the new loan officer training in different areas. We'll put 15 of you guys in a room, and I'll come in for 3 days. I do the CE as well. So I'm familiar with that. Yeah, State Farm will have ABA disclosures for you guys to use. Yeah, you're going to be originating the loan and turning it over to your center, right? But you're still, State Farm Bank is different than State Farm hazard insurance, etc. So you will have ABAs in your package for your borrowers to execute. Even though it's obvious, we still have to disclose, okay? All right. And remember, a markup or an upcharge, I'm going to charge you more for what somebody else is billing me, right? The appraiser's $450, I tell you $550. The appraiser bills me $450, I pay them $450. They're not getting a dime of the upcharge. So it's not a kickback, it's not a fee split. They're not paying it to me. I'm collecting it and skimming off the top. That's a markup or upcharge. And the Supreme Court says if it's not split, it's not a violation of RESPA. It's not a kickback. It's not a referral fee. I'm charging more. Now, that says it's not a violation of that portion of RESPA. A lot of states have unfair deceptive act and practices laws. It might be an unearned fee. That's part of RESPA, but it's not a violation of Section 8A or 8B, which is the referrals and the fee splitting and the kickbacks and all that. So it's the controversy. If it's not split, not a violation of RESPA. That's a markup or a unilateral. Una meaning one, right? Unicycle, unicorn. One way. Only one person's upcharging. The other person has nothing to do with it. Not a split, not a violation of those sections of RESPA. All right, so that's what we want to cover under RESPA. Under TILA, we're going to talk about mostly advertising here, and remember what trigger terms are again, right? One of the principal ethical problems that TILA is intended to address is deceptive and misleading advertising to solicit business. Typical violations include using trigger terms such as low monthly payments without stating the terms of repayment. All right. The APR is the most frequent required piece of information we need to put on ads. If it has anything to do with finance charge, payment, rate, whatever, man, APR is a big fix-it. APR is a big fix-it. So there's a lot of ways to deceive and mislead advertising in the mortgage business. And because of that, after the run-up and the collapse 2008, the Federal Reserve, prior to the CFPB, created new tightened advertising prohibitions for Reg Z, new trigger terms, new advertising requirements, and they came out with our 7 deadly sins. Right? You cannot mislead about your fixed rate and payments. You know, we used to have the monthly ARM, NEGAM ARM, and they'd advertise it as fixed at 4.5%. And then the rate was fixed for 3 months, and that would be advertised as fixed. Now, fixed at 4.5% for 36 months, for 3 months, subject to increase, and possibly be higher at that time. Some type of verbiage like that. You have to say fixed for how long, and the fact that the rate will adjust and most likely subject to increase after that time. Right? Hey, refinance today and save $500 a month. Not good enough unless we say compared to what, right? It's one of my favorite things in the world to say, especially with rates. Compared to what? Compared to on a $350,000 loan at a 3.25% APR and a 360 month. Maybe with more details we could do it, but you can't just say save money without giving them basis for what you're basing that on. None of us have a special government program, a government endorsement. We don't have the picture of the Capitol and an American flag flying, etc. Right? That would be a government endorsement. We don't get to say that. And misleading current use of your current lender, not allowed to say. Contact us about your Chase mortgage. You're not Chase, you don't get to use that term. All right, that's our first break. We got a 10-minute break. See you back here at the top of the hour. You claims about eliminating debt. We can't be called counselors unless we're a nonprofit. We can't give the trigger terms in a foreign language and all the other information in English, right? And also the tax advantages and tax deductions over 100%, which doesn't happen in today's world. We don't have that type of product. But those are the 7 deadly sins and the prohibited practices. Now, Reg Z also prohibits misleading terms for open-ended free money and you're fully approved or you've been pre-approved or lowest rates. Right? We can't offer things that we don't know we can offer. We can't promise or advertise that we can get you the lowest rate when we don't know anything about you, your income, your assets. You may be someone that does not qualify for anybody's lowest rate, things like that. So we can't offer things we're not sure that can be available anymore. And there's different stuff out there with the FTC. They've got a web page that says that's called deceptive mortgage ads, what they say, what they leave out. So, there are questions like, well, how much are the payments? Does it include taxes and insurance? Does it have a balloon? Is there a prepay? Not applicable in today's world, but, if it has a short-term teaser rate, can I refinance without paying a penalty for the rate resets, which makes 0 sense at all, the cost involved? But okay, that's what they say. So the FTC consumer alert on deceptive ads is available online, things like that. In 2011, the FTC said those 7 deadly sins, the Federal Reserve are fine, but we've got more. We're going to create the MAP rule, the Mortgage Acts and Practices rule, which prohibits any material misrepresentation expressly or by implication in any commercial communication regarding any term of a mortgage credit product. So there's 19 additional. You cannot misrepresent these issues on the mortgage. All right, under the MAP rule, if we're using commercial communication for products, we must keep copies of anything: sales receipts, training and market materials, on hold music or scripts, and anything disseminated for 24 months from the last date the person made or disseminated the applicable commercial communication regarding any mortgage product. So got to keep stuff for 2 years. You cannot misrepresent. So a lot more don't misrepresent. At the bottom of that page, the Bureau continues to demonstrate its commitment to address deceptive advertising practice. In 2012, it issued a warning to our industry about the use of deceptive ads. In 2014, they brought action against a lender that led to a settlement of over $19 million. 19. All right. Alleged violations that led to this settlement included low rates that we didn't have available, not we, they. And within the first 4 months of 15, the Bureau also had enforcement actions with 4 separate lenders for using advertisement that falsely suggested a relationship between the mortgage products and the U.S. government. People say, I see that all the time. It's like, yeah, but they're sweeps. They conduct sweeps. They look for things. People are getting in trouble all the time. Again, you can't catch everybody, but I don't want to be caught, so I'm not going to do that. All right. So U.S. government, these complaints are violations of TILA, and the parties of these actions paid penalties ranging from $85,000 to $250,000. All right. Advertising, TILA. You must tell the truth, no misrepresentation, and no using fancy language or referring to their lender or government endorsement, things like that. What else did TILA do? Well, in 94, Congress amended TILA with the adoption of HOPA loan, Home Ownership Equity Protection. So it was the first anti-predatory lending law, and we've changed HOPA a few times over the years. All right. Most recently, in 2008, we created a ban on equity-based lending. All right. We must not base a decision on a loan based on the fact that the borrower has a lot of equity. All right, yeah, I'll give you the loan. You got 70% loan to value. Sure, I'll give it to you. I don't think you're going to be able to pay it, but that's fine. I'll just foreclose. And we had lenders making loans with the anticipation that they were going to foreclose, which is another violation. All right, so you got to base it on what? The borrower's ability to repay. So borrowers accepted high-cost subprime loans found themselves in an endless series of lending transactions. They refinanced one bad loan to another as well. So equity-based lending led to equity stripping. We'll just keep coming in and refinancing you every year or so, again and again, helping you think you're getting a better deal when we're just burying you deeper in debt, taking and stripping away your equity until the equity position was no longer feasible for us to, all right, well, now it's time we take any more, we're not going to make any money when we foreclose, so we're going to stop now, and then we'll sit around and wait for you to finally default. Then we'll come and foreclose and finish taking all your equity. Equity-based lending, equity stripping, loan flipping. We also call it churning. Loans, churning them over and again when there's no true benefit to the borrower. We're just doing it to make money and to take advantage of people. So there's a prohibition against refinancing within 12 months of the original extension of credit, unless it's in their best interest. And now most investors, most lenders make us do it if it's in their best interest anyways. You know, if you're a lender and you're found that you're letting people churn product, even if it's over a year, wait, you're putting people in new loans that cost them thousands of dollars, and that's taking advantage of them, so that's probably not a good idea. So what happened to HOPA most recently? Dodd-Frank mandated changes to HOPA. And the first thing is protection to more mortgages, all right? Not just, it was owner-occupied, refinanced, and closed in seconds. Now it's any owner-occupied property, purchase, refinance, construction loan, closed in second, even a HELOC. So any of those loans, which is pretty much all of them that you can get on a home, that exceed any of the three thresholds of HOPA, APR, points and fees, or prepayment penalty, which doesn't really come into play right now, but the other two is subject to the rules of HOPA. So they added more loans. They added that prepayment penalty threshold. It's like, well, a few years ago we were slapping all these 5-year prepays or these more, these 5% prepays. Those were a little overzealous, so we're going to make those different rule. All right, so we added a prepayment penalty threshold. If it's for more than 3 years or more than 2% of the principal balance, that's excessive. That makes it a high-cost loan. All right, so we extended HOPA. We added the prepayment penalty threshold and added more items to the points and fees. So loan originator compensation, different things. If we have an affiliate business arrangement with these other firms that we're doing business with, some of the income we make from that goes into the lender's points and fees. If we require the use and have an interest in, then that whole fee could be part of our 5% points and fees, and that gets it. That's where it can get pretty shaky pretty fast. We want to make sure that doesn't happen. So those are the changes that we made to HOPA. And the last thing, finally, by requiring thorough assessment of borrower repayment ability that is based on what? The consumer's current and reasonably expected income, employment, and assets other than the collateral, we can't make the loan high-cost loans. All right? So amended TILA was prohibited. Also, TILA was prohibited. An amendment, Dodd-Frank created what? A change in TILA called the ability to repay rule. All right, the ATR rule, it was in 2008, it was placed on HOPA, high-cost loans. They created HPML, Section 35 higher price loans around the same time. That also had an ATR requirement. And then in 2012, when the Bureau took over, they started setting the groundwork for the Qualified Mortgage ATR regulation, which took effect January 10th of 2014, so 2.5 years ago. So what's included in the TILA's ATR rule? Primary as well as second homes, first and second or subordinate liens, purchase money mortgages, refinance, and closed-end equity loans. So subordinate liens that are closed-end are included. What's not included? HELOCs. Unless it exceeds the HOPA thresholds, there's no regulation that we have to have ability to repay on a HELOC. There's shown very little evidence that people were put in a bad position or overextended themselves, et cetera, et cetera. They can go get a credit card or they can get a HELOC. They're going to spend the money either way. All right. Reverse mortgages aren't included. You don't have to have the ability to repay a loan with no payment. No temporary, anything that's temporary, bridge loans or construction loans, 12 months or less. And the good old timeshares, you don't have to afford a timeshare. All right. Because you're not going to lose your home. You're going to lose your time that you're sharing. If you don't have a timeshare, you're going to have a bad time. Anyways, one of my favorite South Park episodes ever. The timeshare in Aspen. Anyhow, what else has TILA done to protect the consumer? There's new rules regarding compensation of mortgage brokers. Lenders, too. They use the term brokers, but we can't get paid on any other terms of the transaction. No terms of the loan. And what do? If you pizza when you're French fry, that's right, Thomas. Thank you. Thank you. You're going to have a bad time. Pizza, French fry. Anyhow, I regress, but that's what I'm good at. What do we do with yield spread premium? We charge the borrower a fee and we put the yield spread premium in our pocket and make double compensation? No. We give them a credit for all their yield spread premium. We use a credit. It can pay our fee. It can pay our origination fee. It can pay the broker fee. It can pay our processing fee. It can pay a ton of fees. But we have to disclose that they're accepting a higher rate. And with that higher rate, there's money being created on the back end called yield spread premium. And with that, we are going to give borrower credit for that money. So no terms of the transaction other than what? Loan amount all day long. No other terms of the transaction. We can't pay more for this loan than that loan. We can't pay more for in-house versus brokering it. We can't pay more for how you structure your loan and how much money we make. You get paid the same amount on that loan amount or that same loan all the time. Borrower credit is what we do. No steering. That's putting people into a loan with maybe better for us, myself, or maybe just my company. So I'm going to steer the borrower this way because we make more money. It's a better loan for us. No, not allowed. Those are the three things. So the TILA defined what originator compensation is and who's an originator covered under the regulation. So they said an originator is anyone who earns compensation or expects to earn compensation for doing these things, these loan officer things. Right? Taking an application, arranging credit, making extension credit, referring your credit to, etc. Right? You see that there. So anything we do that has to do with being a loan officer says you're a loan originator and you are covered under LO compensation rule, which means you're an employee, agent, or contractor of a creditor or a LOO, a loan originator organization, if you meet the previous definition. And nothing can affect your compensation, such as terms of a loan. So no change in salary, no commissions, no bonuses, no trips, or anything else based on any terms of a transaction or any of the legal compensation ways that we've outlined. All right, so what do we get? No compensation on the terms of a transaction, no charging a fee and keeping yield spread premium, no dual compensation, and no ability to steer. Under this, steering, directing, or steering a consumer to consummate a transaction based on the fact that the originator will receive greater compensation from the creditor, etc., is steering. All right, so in order to be able to show we are not violating steering, the loan originator must obtain loan options from a significant number of creditors where they regularly do business. So if you're a broker, you've got different lenders you use. If you're a lender, you've just got your own myriad of products. All right, for each type of transaction, we must present the loan with the lowest rate, the loan with a rate that does not have risky features, and the loan with the lowest amounts of points as well. So there's some other rules there that we have to pay attention to. So it's a very complex rule with numerous provisions that address the fine points of what constitutes compensation with illegal compensation practices. So a lot of people go back and forth and try to recreate, make a new cooler wheel for compensation, and I've seen a few things here and there, and I've seen a few people that come up with some great ideas that the CFPB has come in and said, yeah, no. So pretty much same percentage, same flat fee. Don't get to be too creative. There's not a little creativity. All right. Let's look here on page 330 what Mortgage Pro is doing. Let's see if they're doing it right or not. 330. So, is the way Mortgage Pro is calculating compensation okay or not okay? Can we pay the originator a percentage like that? Oh, well, we're doing the discussion scenario. Oh, well, yeah, there. Knowledge checkpoint. Yeah, you guys putting the answers out, right? Law prohibits originators from, yes, steering borrowers towards transactions. Yield spread premiums. Thank you, Eric and Cheryl and Jordan, for catching me off guard because we're doing the scenario, but actually that came first. And we are prohibited from receiving, the last one is, there it is, Cheryl, dual compensation. All right, so now the discussion scenario. Is Mortgage Pro's method for calculating creditor or originator's compensation, they doing it right or are they doing it wrong here? Did we read that on page 330? That's what I thought we were doing, my bad. All right, so someone said they're doing it right. Everybody agree with that? They're paying their originators 0.5% of the fee earned from the lenders. And the answer is, Charles says, no, that's not right because they're paying a percentage of the fee, right? If I realize that I got a higher fee at lender A versus lender B, that would create an opportunity for me to do what? Steer that client to A because I can make more money. If we make $2,000 at lender A and I make $2,500 gross compensation at B and I get half of the compensation, I'm going to steer borrowers to where I can make more money. So that's wrong how they're doing it. It can't be a percentage of the fee earned, because then we could charge more fees so we can earn more money, which is what we always did in the past. Right, you could raise the fees so I can make more money. What could we make the change? Instead of 0.5% of the fee received, we could pay them 75 basis points of the loan amount. Loan amount. All right, so if they got a bigger yield spread premium and he got a percentage of that, he would put buyers in higher rates to get a higher yield spread, etc. All right, so we can't steer, and that would create a violation. So we're paying them on terms of the transaction, how much money we make, which would create an opportunity to steer. So what do we want to do? That's right, Charles, BIPs. What could they change? BIPs on the loan amount. Life's about the BIPs. And of course, yield spread premium, what do we do with that? Can we still use it to do no-cost loans? Heck yeah, that's what we've been doing with it for years, and then people took advantage of it. All right, so yes, we can. Yes, we can. All right, GLB. Sorry about that. Bramlage-Bliley, ethics of Bramlage-Bliley. So one of the most important ethical considerations during transactions for loans is the obligation to protect the privacy and the confidentiality of the personal information that consumers provide. Check this out. This is one of my favorite stories ever. In the 1990s, it became apparent that personal information was not only protected, but it was being sold for profit, considerable profit. In 1999, the Minnesota AG revealed that one of a Minnesota bank had sold customers personal information. What did they sell? Oh, not much. Just their checking account number, their credit card's numbers, their demographic data, summaries of their checking account and credit card activity, their credit score, their homeownership status, their name, their phone number, their address, and they only got a measly $4 million for selling all this information to a telemarketing firm. And they're a bank. And when the AG came and said, hey, you can't do that, I'm filing of action against you, they pulled a George Costanza and said, what, was that wrong? Because I got to plead innocent here. If anybody would have ever told me that that was wrong, I never would have done it. Really? You just think that that's okay to sell all your customers' private information so you can make millions of dollars and just throw them to the wolves? Their credit card numbers are out there and all their information. So that's kind of what they started seeing in different states, and the U.S. Congress is like, whoa, maybe we should not allow banks to do that, or any financial institution. So now, under the Gramm-Leach-Bliley Act, financial institutions have specific legal obligations to protect the privacy of consumers' personal financial information. All right. The original act wasn't even about privacy. It was called the Financial Modernization Act, and that was to eliminate barriers and restrictions between different sectors of financial service industries, such as between depository institutions, investors, and insurers. But over the time, they realized there were some other things. So Title V and the GLB have established that financial institutions have specific legal obligations to protect the privacy of our personal financial information of our consumers and customers. All right, so Regulation P, because it's all about privacy and protection, and that is CFPB implement and authority. So what do we do? First of all, they've eliminated some of the things. You couldn't give us sell Social Security numbers. You can't sell account numbers. We can't transmit account numbers anymore. So there were new limitations and restrictions on if you do sell, what you can and can't sell. So they said half of the stuff, you can't even sell that if the borrower, even if you wanted to, or the borrower didn't care, you're still not going to sell that stuff. And the second thing is they've given us the ability to what? There's limitations and restrictions on what they can sell. And now, if we sell anything other than to third-party providers that have to have it, and we don't sell that, we give it to the title company, etc., we have to give the borrower a statement upfront and then annually, right? This is the information that we share with non-affiliate third parties. And if you don't wish to share this information, here is a reasonable opportunity to opt out. We got to give them a 30-day window at least, and a simple thing like a phone number or a website to go and opt out. All right, reasonable opportunity. We don't ask their permission to share information. We tell them this is what we're sharing, and if they don't opt out, we will continue to share it. And then the servicer and every financial institution sends out that notice every year. All right. So now the obligation for non-depositories, what they found is lenders, like our lenders, mortgage lenders, and brokers, typically don't share third-party information to non-affiliate sources. It's not part of what our practice is. We're too busy trying to get this loan closed in 30 days. So the obligation for non-depository institutions like bankers and brokers provides notice, and there's different notices we can provide. Whether we share public, non-public information with non-affiliate third parties, and whether the transaction's a consumer or a customer. Well, in our world, as soon as they fill out an application, it makes them a customer, which is the highest level of protection we have to have. So customers must always receive initial notice, all right, which is due as soon as the consumer provides any personal identifiable financial information to the mortgage professional in an effort to obtain a mortgage, all right? So the initial notice must explain our policies regarding collection of non-public and sharing it with third parties. If we don't share it with third parties, there's what's called the simplified notice. The notice says we do not share public information, personal non-public personal information with non-affiliate third parties, and we only share that information in order to process the transactions that you've hired us to do, such as the mortgage app. All right? We don't share it with third parties. We only share it with affiliates that need to have it to do the loan. It also includes a statement that we do not disclose to non-affiliated third parties, a description of the categories, etc. And basically what we do is we don't give them an opt-out. Right? You cannot opt out from me sharing it with the credit bureau, with the title company, with the lender, with the investor, with the servicers. That's part of the process. We all have to do that. So if that's all we do, we tell them that's all we do and what we share, and there is no opt-out. That's the simplified notice. And most lenders use the simplified notice because during the process of the loan, we do not share that information. When we sell that loan to the secondary market or we service release the servicing, now whoever has that has to give them the notice of what they share and the opt-out annually thereafter. All right? And then the second half of the GLB is the safeguards rule. It was originally established by the FTC, and as directed by the GLB, they established standards for non-depository mortgage lenders and brokers and originators to follow when we create and implement our administrative, technical, and physical safeguards to protect the security of confidential information, protect against unanticipated threats to the security of the integrity of our customers' information, protect against unauthorized access of the customer information, and that's what's known as the safeguards rule. So they give us an outline of the elements that we're supposed to have in our protection program. You see it there. The rule generally requires to develop, implement, maintain, etc. All right, and the 5 elements that they give us: designate an employee or employees to be the coordinators of the program, identify internal and external risk, implement the program, testing it regularly to make sure it's effective, oversight of third-party providers, which includes obligation for mortgage professionals to ensure that our third-party settlement providers adequately safeguard the security that we provide to them. Really, it's our job to look over a multi-billion-dollar title company. They can't be responsible for their own selves? Apparently not. Apparently not. So the GLB creates numerous compliance issues for mortgage industry, and with the FTC and the CFPB sharing authority, its requirements demand ongoing consideration. Compliance department. That's a lot of the people that handle this stuff to make sure that we're in compliance with all these laws. Like an originator, what am I going to do? Make sure that everybody I talk to has, something like that. So that's that. All right. So Mortgage Pro is a small mortgage brokerage company. They do not share non-public information with third parties. They only share it in order to process the transaction. Is this a time when we would be permitted to use the, quote, simplified notice? And that's exactly, right? Yes, yes, yes. That's exactly when we're supposed to use the simplified notice. All right, to review ECOA and touch on some other fair lending stuff, ECOA, Equal Credit Opportunity, right? Regulation B, as in it says, be fair and treat everyone the same way. We cannot ask or use, if we do have this information, because we have to get it, we can't use the information to determine their credit worthiness, race, color, religion, national origin, sex, marital status, age, and if they get public assistance. Right? We cannot discriminate based on those factors. We can't even consider those factors in our process. All right, and most people other than mortgage companies never get any of this information at all. We never ask race, color, religion, national origin, sex, marital status, or on a loan application for a car loan or for a credit card would never be asked. But because of HMDA and because of marital status for what? Lien perfection, we've got real property that has title, and there's legalities between if you're married or not, who has rights to that property and how it can be affected. We have to ask those things. But we don't use it to determine, well, now you're married or you're not married. Well, we're not going to give you a loan because you're not married anymore. It has nothing to do with anything. All right? So ECOA prohibits creditors from making inquiries about any of those things, except, of course, mortgage companies. And remember, ECOA is where we got the original redlining regulation. We can't eliminate parts of town or zip codes or say, these people in this area, they don't make a lot of money. Over here, they don't speak a lot of English, so let's not lend in there. That's redlining. I just drew red lines around parts of town that I'm like, no. And that contributes to the decay of struggling areas. When you stop putting credit availability into areas that are hard hit, then they just completely become just decimated financially. So no redlining and no reverse redlining. If we target poor credit risk neighborhoods to go in and take advantage of them with predatory loans, that's known as reverse redlining. And that also is a violation of ECOA, redlining and reverse redlining. All right? And remember, well, I'll get to that at the end. Next thing we're going to talk about for a minute, we didn't get to this at all, was Fair Housing Act. The Fair Housing Act was passed in 1968 for three goals: to provide fair housing throughout the United States, prohibit discrimination in the sale and renting of all housing, and discrimination in mortgage lending. So this was 6 years or so before ECOA said no discrimination in mortgage lending, no discrimination in who can live in what neighborhood or who can live in what building, or a lot of different aspects of fair housing. So this is a regulation that our real estate agent partners, our builder sales agent partners, and condo salespeople and apartment leasing agents and property management companies that rent properties have to really abide by. Right? They can't ask questions or answer questions regarding race or color, national origin, religion, sex, familial status, or handicap. So you can't say, I don't want you to live here because you have kids. I don't want to rent to you because you are a single parent. That would be familial status. You also can't refuse to rent or sell a house based on the fact that somebody has a handicap, or the other race, color, national origin, religion, sex, right? Notice age isn't on there. But there is one caveat to the Fair Housing Act, and that's familial status, right? And there are 55 and older communities, and they have maintained that status by certain caveats in the law that say you can maintain your adults only 55 and older if it's posted. If it's, how do you know a community is 55 and older? Because it always says so. First of all, it always says so. You can't have it without saying it. Oh, a 55 and older community. Del Webb, so 55 and older community. Over here in Stapleton, where my girlfriend lives, they've got all these new construction projects, and 55 and older. They all say it. All right, that's part of the exception to the rules. It has to be stated. The villages. Love my stories about the villages, but I can't tell them. Right? The villages. My mom lives up near the villages. She lives in another 55 and older, more in Leesburg, not quite so far out. But yes, thousands and thousands of retirees live in the villages in Florida. There's these villages all connected with golf courses and paths, and they all have their carts, and it's all 55 and older. Few hundred thousand people live out there, right? It's massive, and it keeps growing. So that's legal. Any other discrimination is not. This is promulgated by HUD. HUD is in charge, all right? HUD's in charge. And remember, we understand federal housing and ECOA. It does not preempt state laws, which can be more strict. There has not been a change in federal law regarding sexual orientation, LBGT, gender, those kind of things. That's been brought up. It hasn't passed, but certain states have passed more restrictive fair housing laws. Certain communities, City of San Francisco, has passed more restrictive fair housing laws there that cover other things. All right, so know what your local and state laws are. If a state or local law is more restrictive, more strict than a federal law, then that's when the state law or the local law takes effect. When it's as strict within more, then it can be. It can't be less. All right. So be aware. The last paragraph above ethics and disclosure. Remember, the Bureau and the Department of Justice have made fair lending a top priority. The CFPB has a special office devoted to fair lending that's known as the Office of Fair Lending and COA and Equal Opportunity. So any actions for fair lending laws such as the COA and Fair Housing Act can be referred to the Department of Justice, and it has a separate fair lending unit of the Civil Enforcement Division. It's a big deal, and they will fast track it, and they will investigate, and they will fine you, and you will get smacked around mercilessly if you get caught being a discriminatory lender or realtor or rental agent or any of those stuff. All right? They'll make a federal case of it. DOJ makes a federal case. All right, ethics and disclosures. We've seen a ton of disclosures yesterday and Monday, right? All these disclosures have different rules regarding the timing and the format and the purpose, right? The purpose is to give borrowers information that should help them make a sound decision about lending products, as well as what their rights are. All right? Failing to provide them with all these ethics, these notices, is a violation of ethics. We found a lot of predatory lenders a decade or so ago that were putting people into extremely expensive predatory loans like subprime loans when the borrower shouldn't have even been put into subprime. We're really good at eliminating and not quite putting out all of the disclosures, like rescission notices. Whoa, rescission notice, let's just keep this here and get the borrower to sign everything, and then we'll maybe do a little of our own John Hancock and slip it in there and forge it. We don't want them to know that they've got 3 days to ask questions and decide if this is a good move for them or not. They might actually finally realize that we're ripping them off. Let's not do it. So failure to disclose, failure to give the disclosures on time and to explain them is a violation of ethics, right? Email and secure electronic document handling are also becoming common methods for providing documents. All right, so one provision of X provides that RESPA disclosures may be provided in electronic form. Again, compliance with what? The e-Sign Act. So make sure we review the e-Sign Act and know when we can do it and when we can't do it and what we have to let the borrowers know about and things. It's a short section in the first day, federal law. All right, ethics and disclosure. All right. Also, the time frames. We're going to really want to pay attention to those little cheat sheets we gave you about timing, application. When are these ethics, these disclosures required? All right. Within 3 days of completed loan app is the answer on a lot of them. Right. Immediately upon referral. Right. At or before consummation. All right. Appraisal. Ethics and appraisal. A lot of changes that were preempted or set into motion by the Dodd-Frank. Yeah, Rachel, you're right. I have a thing where I like my borrowers to understand, but our job is to disclose on time and in the proper form. Right? We only have the burden to disclose on time and in the proper form. Right? If a borrower understands it or not, you know, there's sometimes with students, it's like they ask 3 times, like, I don't know how to explain it to you again. I don't know how you're going to understand it if you haven't understood it now, right? It happens. Different people are in different planes. But yeah, ours is to disclose legally. Professionally, I try to take it a step further. So what's the appraisal? Well, the appraisal is so important, right? We've got this collateral, this real estate that is our collateral for a loan. And we've got all these rules regarding mortgage insurance, PMI, MIP, and VA funding fee. And a lot of those, how much we charge for the insurance is, or how long the insurance is on there, is predicated on what? Loan to value. Right? So if we have a bad appraisal that really overvalues the property, and we're doing a 95% loan with PMI at 17% coverage, but the appraisal is $25,000 over what the real market condition is, we don't have the right coverage. So if that loan defaults down the road, we may have PMI, but we don't have near enough because we had a falsified appraisal, etc. Right? So if we overvalue a property and the market's not really going up, it's not a hot market with a lot of appreciation. We may have the wrong PMI, the wrong coverage on there for quite a few years, right? And the earlier the loan defaults, the more loss there is because the more they owe on the balance, right? So especially up front, we have an issue. So it's a big important aspect is that we have appropriate appraisals. All right. So during the boom, as they call it, they said a lot of pressure was placed on appraisals to bring in a specific value to make our loan work. All right. Push it. Now, I think a lot of that had to do with the rapid escalation of values. We had massive appreciation really quick because of what borrowers were willing to pay. So the pressure was keep up with the market. And it's tough to keep up with the market. We're using comps, and now we're selling the house. Every time a house was selling, it was setting a new record. So we kept trying to chase that and get the appraisals to meet because, if the appraisers don't do a good job for the lender and our deals keep falling short, we're going to find somebody else to use. So they felt appraisers being pressured. And I'm sure there were in a lot of cases, right? So they've got new appraiser independence rules. All right. So the Dodd-Frank provisions are found in the basically say that are intended to protect appraiser independence by prohibiting coercion, bribery, or any other action intended to influence the judgment of the appraiser. Appraisers and appraisal management companies may not have a financial or any other interest in the property. I may not have a financial interest in the property, but my brother owns the house. That's an other interest. I might do, I'll give you a little fudge here for you, help you out. That's other. Couldn't do that now. So we knew how. Also, the extension of creditor. If we know there's been a violation on coercion or prohibition against conflict of interest. It says if we find out this appraiser that did the appraisal for this property, maybe not on that particular loan, but we felt he had a conflict of interest or he was involved in coercion on another transaction, that we're not to use that appraisal until we do our due diligence. Do an appraisal review. Look at the comps. Have our underwriter double, triple check to make sure there is no funny business on this one. Just because he had a breach of ethics over here because he knew the person doesn't mean every appraisal they're doing is wrong. So it says don't use it until we determine whether we should or not. All right. So the law also mandates highlight reporting appraiser misconduct to the state appraiser licensing authority. If we get appraiser misconduct, they have an interest in a property, they've been swayed or coerced or just flat out done a horrible job and wouldn't work with us to fix it, and even came in $50,000 under. We're worried about overvaluations. That's when we're challenged, but an undervaluation is also a misrepresentation, and if they don't work with us to fix it, we would have to report appraiser misconduct. All right, and we're required as lenders to always pay reasonable and customary fees to appraisers. They don't get paid for closing loans, they get paid for appraising. All right, so in the new world, those are I'm behind a slide, sorry gang. So there's new valuation independence. Now they changed the terminology. Instead of saying appraisal, they're using the term valuation. That's an appraisal. You're going to evaluate. You're going to give me a valuation of a property. You're appraising it. So we'll just use appraisal, but valuation independence rule is the appraisal independence rule. So in 2010, the Fed Reserve issued an interim final rule. I love the final rule, the first final rule, the interim final rule, the final rule until we change our mind. How do you have an interim final rule? To implement provisions in Dodd-Frank that address appraisal independence. These are now known and enforced by the CFPB as the appraisal or valuation independence rule. So what does it cover? Well, let's start with the bottom, cover transaction. Anytime consumer credit is applied for and will be secured by a consumer's principal dwelling, their primary residence, it's a covered transaction. So if we're doing a second home or an investment property, you can lie, cheat, and steal all you want, appraisers. I don't understand why it's only primary, but our principal, I use that as a way to trigger that. So you remember only on principal dwellings. And everyone who is a covered person is covered under the rule, which says any creditor or any other person that provides a settlement service in that transaction is covered. So we can't have real estate agents trying to bribe the lender who is going to try to bribe the appraiser or any coercion between those aspects, all right? Independence, covered transactions. So instead of referring to appraisers, they talk evaluation term. And that just is an evaluation, an estimate of the value of the consumer's principal dwelling in written or electronic form, other than one produced by an automated model. So if we're using an AVM, an automated valuation model, we'll pull those up to see what the value of a refinance might be or to check some comps. We can kind of do a computerized appraisal, which doesn't count for loans. We're not talking about that. When an appraiser goes out and inspects the property and compares the houses and does the measuring and all that, that's a true valuation, and that's what's covered. So most of us have valuation management functions, or AMCs, appraisal management companies, that we now work through to get our appraisals. All right, so instead of having a relationship with my friend Paul at Paragon Appraisals and knowing that Paul's going to take care of me and he's going to respond to me and call me back and work with me and help me back and forth, who I used for 20 years, instead of me calling Paul, I can't call Paul anymore. So Paul, the independent appraiser, lost all his clients, and he's now no longer self-employed and happy as can be after 20-some years in the industry. That's my whole about putting the independent appraiser out of business. Now I have to order it through a management company. And the management company is involved. They then select, contract with, and employ the people to do the appraisal, the valuation. All right. So then the appraiser goes out, does the valuation. They then submit it back to the management company. So they manage, oversee, and administer the receipt of the orders. And then they process and prepare the valuation and submit it back to the creditor. And then they bill the creditor, and I pay the AMC, and they take a nice chunk of change off the top, and then they pay the appraiser a much smaller fee. All right. And they can also perform reviews and verify the work of the people they've hired to do the valuations, the appraisals. So most of us go through AMCs now, and that's the arm's length, right? I can't call Paul. I order it through AMC, Big Appraisal Inc., and then they will select which independent appraiser does it. All right? Valuation management function. So under that broad definition, their evaluation functions are not limited to the actions of appraisers, but include the acts of the creditor, the mortgage broker, the originators who would order them. So basically it says no coercion. No one shall or shall attempt to directly or indirectly cause the value assigned to the principal dwelling to be based on any factor other than the independent judgment of the appraiser. So no saying, hey, if you don't bring me this value that I want, I'm never going to use you again. No saying, hey, man, if you give me $400,000 on this deal, I got a lot more appraisals for you. No saying, hey, you didn't bring in at 400, I'm not paying you. I want to get another appraisal. I told you I needed 400. Stinking guy, I'm not going to pay you. That would be a violation. You can't exclude them from future consideration. All those coercion things there. No misrepresentation. No person that prepares valuation shall materially misrepresent the value of a principal dwelling. That means up or down, high or low. It's a material misrepresentation. It's considered a material if it is likely to significantly affect the actual value assigned to the dwelling. Okay? No extension of a credit when we know violations occurred. I've already described that. And no conflict of interest. No direct or indirect interest the property from the appraisers. All right. So, in order to understand the scope of conflicts of interest, become familiar with the interior of the rule. All right. We can't use a staff appraiser. We can have. How do we have staff appraisers? We can as long as there are firewalls between the originators, us, and the actual appraiser. All right. So, when I first went to Florida in '97 and was EVP of retail, we were only retail at that time, we had a staff appraisal in Central Florida. We didn't have one in our Tampa office or our Jacksonville office, Fort Myers, but we had one in our main location, Orlando, where we did more business because that's where we started, and that's where we were always the strongest because it was our own backyard. So we had an appraisal department, and George technically came under the direction of the VP of production, which was me at the time. And when we left the corporate office, because we outgrew it, we got a new retail office. George and his entire staff of appraisers came and were housed in one of the main retail branches of the company. They came to our office meetings. They ate our food when we brought it in. They mingled and mingled back and forth with our originators. We had talks about the appraisal, how fast can you get it, blah, blah, blah. That could never happen today. They would not be there, and they would have to report to somebody other than somebody involved in mortgage loans, like underwriting or compliance possibly. We can't pay them based on the value, and we can't, and that's not based on closing the transaction either. All right, so if we're a larger creditor of over $250 million in assets, that's our rule. If you're a small creditor, you just cannot base the compensation on the value of the appraisal. So those are the firewalls of the rule. So we can have, and a lot of bigger companies do have, their own appraisal departments. They're just separate entities now with no back and forth. All right. Now, what happens after an appraisal comes back and we're like, dude, this appraisal, your comps are far, this comp's excessive adjustments, what's going on here? Well, before the appraisal is done, we don't really have a chance to talk to them and have a little tete-a-tete about what we want. But after the appraisal comes back, it's not illegal, and we now have the right to say, hey, there's some better comps that I've taken a look at much closer to the house that give us a little different take on what value you got. Would you mind please looking at these comps and telling me why you didn't use them? Or please redo your appraisal with these comps that make sense. The underwriter can say, I'm going to condition the appraisal. I want further substantiation or explanation for the appraiser's conclusion. Comp 3 is too far. Comp 2 has excessive adjustments. I want to replace those comps. We found some mistakes. You need to correct your errors. You know what? I don't like this appraisal at all. There's too much going on here. I want to order a second appraisal. We're going to use the appraisal that we determined best values the property, not necessarily which is highest, wink, wink, but what's best. And we can withhold compensation to appraisals if there's a breach of contract or we decide that there's a substandard performance of services. They just did an awful job. They didn't work with us. It was sloppily prepared, etc. Then we have some rights after the fact. All right? That's the new valuation independence rule. All right? The regulation also includes, remember, reporting a requirement that applies to appraisal misconduct. All right, let's take a look at the scenario on 341. What's going on? All right, let's answer the questions first. What kind of management functions include the actions, the appraisers, the creditor, the brokers, and the originators? Those are what's the term we're using in today's world? They just use that new word that we usually don't use. And that's it, Jordan. Valuation management functions. All right. The valuation independent rules prohibits interfering with the judgment of who? Whose judgment do we leave up to their own good or no good? That's it, Eric. The appraiser's independent judgment. And if I want to have a safe harbor, I just gave that. The rule creates two safe harbors for compliance for having my own appraisal department. And that's it. We've got some firewalls there between originators and the appraisers themselves. All right. All right. When we get back from our break, which is now, we're going to read the next two scenarios, little quick scenarios regarding appraisers. All right. Well, guys, yeah, I'll tell you when you get back. We've got time. See you back in 10. The valuation rule applicable where we have undervalued. What does the rule say? Material misrepresentation. Does that cover if the appraisal comes in low? We were worried about them bringing them too high. Would it cover that too? Donna says yes, right? That would be a material misrepresentation of their primary. So yes. So is there anything that Mike can look to in the rule to rely on to help him get this appraisal fixed? Does he have any rights now that he's got an appraisal that looks like it was carelessly prepared? Right? The appraiser used a foreclosure and a short sale. All right? If there's 15 comps and there's one or two distressed sales, we don't use distressed sales on non-distressed properties. All right? If we're not in a completely distressed market. Now, in 2009, in neighborhoods in Orlando that I would be familiar with, the entire neighborhood was for rent, for sale, and foreclosure, short sale. The entire market was distressed. So, yeah, we had to use distressed sales because that's all there were in that entire subdivision or subdivisions. But if it's not, we don't use those. So what can Mike do? Nobody's answered that question. What can Mike do to challenge it? Can he challenge it? What can he do? Right? Can he say, this is not for me to discuss, this is for you guys to discuss. I know the answers. Additional info. Can you look at these other comps? Why did you use a short sale and a foreclosure when I've got 10 other comps and not? Now, get a second appraisal is always a choice. But A, then you have to wait more time. Then you have to not pay this appraiser and prove that you didn't pay him. And they're not going to say, hey, it's my appraisal, you have to pay me. Then you're going to pay somebody else who's going to pay for that appraisal, you know, if we don't get this one not paid for. So that's not our first option, is to get a second appraisal. What does the rule allow us? Ask the appraiser to consider other information. If they don't comply, then they report the appraisal. Rachel, that's an awesome answer. Rachel is the teacher's pet in my 10 o'clock hour. All right? Perfect. Based on information, if Mike finds that it was inaccurate and carelessly repaired, does he have a duty to report? Absolutely he does. And then if we don't have cooperation, then we could withhold payment if we found that it was carelessly prepared. The guy's from out of the area, he used comps he shouldn't have used, you're not helping us turn it around, you know what? You are, sir, are a special kind of person, and I'm going to report you to the State Appraisal Board, and I'm going to order another appraisal. I'm not going to pay you. All right? That's it. Let's look at the prohibited interest scenario in 343, those two paragraphs. David and Cindy, what can we do here? What's going on? So the originator says, oh, this transaction doesn't count, and I'm not restricted here. Is this a covered transaction? Is it an extension of credit on a principal residence? It is. So it's a covered transaction. So does that make him, the originator of the loan, a covered person under the transaction? Right. So what's our first scenario? Our first clue, something is amiss here. Hey, I got me an appraiser that's going to give you a real nice value. We're going to take care of you here, right? Does he have an appraiser that he's got in his pocket that he can whip out and say, I'm going to influence this guy and we're going to give you a great value? He doesn't. He can't, right? So he's violating the law. The appraiser's violating the law. And little Miss Cindy says, I'm going to report you. You're not doing it right. Right? He can't promise a value before the actual appraisal. He can't have any influence on the appraiser whatsoever. All right? Now, Cindy, does she have a legal obligation to report David's action under the rule? Or what does she need to do? Right? It's not yet material. Well, it's a violation of the rule. We have a covered person influencing or picking the appraiser. Right? And it's not RESPA. There's no RESPA violation here, Jordan. What we've got is David has a prohibited conflict of interest. By selecting the appraiser, he's performing a valuation management function, and that's the same transaction where he has a financial interest. He gets paid for doing loans. All right, so the independent rules prohibits anybody who's choosing the appraiser from having a financial or other interest. So he can't choose the appraiser, period. All right. Cindy doesn't have a mandatory reporting for David's actions. She has a mandatory reporting limited to the appraiser violation of misconduct and not of the originator. So we've got to deal with David internally. The appraiser is being influenced and shouldn't be doing that. I still need Khalid Wainwright and Robert Greco. NMLS number. Khalid and Robert Greco. Okay, so that's what we've got going there. All right? All right, before I forget, again, I want to do this earlier. On our next break, or if you've got a second here and it's quite handy, we have one more test that you guys were going to use in the last 15, 20 minutes of class, and it's called the end of class discussion questions. It's a separate email, or it's the same email where all the other test is, but a separate attachment. Instead of practice questions, it's called end of class discussion questions. There's 15 questions. 15. So it's 2 pieces of paper, maybe 3 with a cover sheet, that we need to go over the last 15 minutes, and that is in lieu of sending you for a final exam on this course. We all must participate with that. All right, Robert, well, you're back, and give us that. Just check in now. So between now and an hour and a half from now or so, we're going to need those last 15 questions to all participate in our end of class discussion, which is how you get your final pass by participating in the discussion, okay? So it's an email, and it's called end of class discussion. It says 20-hour safe app, comprehensive applying mortgage knowledge to exam prep, end of class discussion review, 15 questions, 15, okay? So we'll need those. All right, fraud, detection, reporting, prevention. Let's teach you how to do fraud. No. Let's teach us how to spot fraud. So we had a lot of different fraud. The FBI says the intentional perversion of the truth for the purpose of inducing another person to rely upon it to part with something of value. All right. So mortgage fraud has a lot of forms. We actually created our own fraud with the products that we allowed, and those were liar loans. Right? Lie, tell me what you make, tell me how much money you have, no proof of income, no proof of assets. We created some loans that allowed people to perpetuate fraud without really doing fraud in their minds. But if they lied about their income, that truly was false information, and it was fraud. But we really, all right, Robert, as long as you did that, you just check in. You did, all right? All right, as long as you meet your check-ins and you take the test and you pass, all right, we'll keep an eye on that. Predatory lending, all right? If we've got lenders, and it says real estate agents, origination, encourage a consumer to purchase a home based on inflated appraisal or steer them towards high-cost products or put them in loans they can't afford based on overvaluations and things like that. That was predatory lending. And the main thing we're going to focus on today is the ethics and the different factors that go into industry insider fraud. All right, fraud for profit, conspiratorial actions of a member of the industry who use lending transactions to secure funds from lenders. With the knowledge of the process, unscrupulous lenders, loan officers, underwriters, processors, real estate agents, appraisers, attorneys, title company people have been involved, work together to close fraudulent loans and pocket the money. All right, so they take FBI, now that we have TILA, the Fraud Enforcement Recovery Act, has enabled us to get the FBI, the IRS, HUD, other government agencies involved. They can refer cases to each other, and HUD says, look, I was looking at this, and I think we got mortgage fraud here. FBI, why don't you take a look? And then if we need to, we can refer it to the Department of Justice for federal prosecutions. So it's a big deal, and we now have TILA since 2009 that finally specifically said we're going to focus on mortgage fraud as well as other frauds. All right. So what are some of the things that are used, in insider fraud? All right. Well, the first thing we've got to worry about is appraisals. When we had inflated appraisals, are one of the most common elephants in fraud. And it says in some cases the mortgages, the appraisals are inflated by much as 100%. I've seen appraisals inflated 300%. I've seen $400,000 appraisals on homes that were worth less than $100,000. Multiple, because we got burned by a scam through our broker channel out of Georgia, Stone Mountain, Georgia. Right? We had $90,000 homes that we did 95% no-doc purchases on with $400,000 values. They did 3 through us. They did about 15 total. They made about $300,000 per transaction. So we figure they walked away with around $4 million after costs and expenses. That's industry insider fraud. So inflated appraisals. What they do, they inflated appraisals. They bought a bunch of houses for cash, and then they sold them to each other. Instead of the $90,000 we just paid for it, I'm selling these to you for $380,000, $400,000. We've got somebody in the title company recording these fraudulent deeds. These sales never happened, but they made fraudulent deeds for fraudulent sales. And now we have a whole market full of what? Comps. We can go out and find 13, 15 comps, all in the $380,000 to $400,000 range on these houses that used to be worth 90. All right, so then we bought them for cash. We sold them to each other to create fake values, and then we went out and we found, so that's proper, right? So now we're going to go out and we're going to find borrowers that we can pay, and that's what we call a straw buyer. You can say, hey Betty, you got pretty good credit, don't you? You want to make a few $1,000s? I'll pay you $3,000. All you need to do is write this contract and help me buy this house. I want to buy this house, but I got credit and I got a new self-employed business, but I'll put up all the money. This lender's got the no-doc loan, so all we need is your name, address, and social security number and your credit score, and then we'll put the 5% down and pay all the closing costs, and then when the deal's done, you know, you'll sign it, you know, you'll transfer it over to us, and we'll take care of the mortgage. I'll make you a few grand. All you have to do is act like you're buying it for you. Okay. So now we've got a property flip with an inflated appraisal and a straw buyer. All right. So they do a 95% no doc because they had a high credit score. They pay them a couple grand. They put it to $5,000, and the seller pays all the closing costs because they're the seller and it's already their money. And then they close on the transaction. The seller gets the check, and they did 15 of them, all within about a 1-month period. 2 months later, we have first payment defaults. Hey, Betty, we're Pinnacle Financial. We're the entity behind TriStar who closed your loan, and we're just looking for that first mortgage payment. What? Boom. We're out $1 million almost on 3 transactions, and all 3 inflated appraisals, property flipping, straw buyers. Straw buyers accepting a fee. Not identity theft. They're acting as them. They just really don't have an interest in the property. They're just doing it in their name for somebody else. I've had straw buyers for profit. Some of the people involved were caught. The main 2 perpetrators, Scott, last I heard, this was in 2004. Last I heard, 2007, when I resigned and left, we hadn't caught them. It was before FERA. We didn't have the FBI involved. We had local law enforcement. They did 15 of them. These dudes are gone. Gone. They made $4 million, $3.5, $4 million, and the 2 main guys, everybody else that they paid a little bit here and there, we caught them. They were in jail for a while, but they were the ones that were duped into making a few thousand. They're not the one that made a few million. All right? So those are techniques. We got to pay attention to certain things. Straw sellers. A straw seller is somebody who falsely claims ownership to a property. One of my students this last week, they did a loan for somebody that bought a house, went through cash, didn't go through title company, through the seller, and the seller wasn't really the seller, and now they own a home that they don't own without title insurance. Always go through title. Always go through title. An heir loan. Never seen it. I've heard about it. When a fictitious borrower obtains a loan and secures it with a fictitious property. I heard that there was American Greed that was showing how heir loans were done. All right, we create a false identity, we create a false property with an appraisal and a fake title report and all this other information, and we get the loan to fund to this fake borrower who puts it in their bank account, which is like what Andy Dufresne did at the end of Shawshank Redemption, right? He created a false identity and all that money went to that guy. I don't know who that guy is. I'm me, right? So a little easier to do in the 30s than now, but it was done. Heir loans. So identity theft. Of course, we know that we've got to be careful and verify identity and look for inaccuracies and inconsistencies in the information to look for identity theft. Always get a good copy of the ID. Make sure the borrower looks like their picture. The Big Short. Yeah, my landlord used his dog's name to buy his house. Yeah, I don't know how the dog had credit, but it could be done. People can create fake identities. All right, good call, Sue. They're late for an appointment. Sale or assignment of contract. Instead of flipping a property and reselling it, fraudulent real estate investors gets a contract, and they just say, I'll sell you my interest in this contract for $10,000. It may or may not be fraud. We used to have a lot of flips going on in the early 2000s in and around College Park and Winter Park areas of Orlando, and we had bird doggers out there that would go tie up properties and find investors to sell the contract to. Hey, I tied this house up for $98,000.
it's easily worth 120 as it sits after you're done with it. I mean, this is one of your perfect flips. This is $250,000 house. Why don't you give me $10,000, $5,000, and I'll just assign my interest in this contract to you or sell you an interest. I've seen it, and we've done some. We just double, triple check some stuff. I don't know if we do it today. That was before the collapse. And then fraudulent brokers or investors who may unload property with an inflated value and a questionable title history. They don't let you inspect the property. I've seen deals where they let you inspect another property. It's not the house they actually wrote up and sold you, but this investor wasn't from the area. We show you this cute little house as the investor. Oh, I'll buy that, just a little touch up here and there, when actually it's a house around the corner that's just a complete piece of crap that they just unloaded on you, and the guy shows up and then comes back to our office like, this isn't the house I bought, blah, blah. And we're like, well, it's the house and the contract and the title and the appraisal and everything else we did. It's back before the buyer required to get a copy of the appraisal, so I don't know that he got a copy of the appraisal because he didn't request one, possibly. But it happened. It happened. So different techniques for fraud. All right, then it goes into FARA, which I kind of started with. All right, FARA authorized resources to address mortgage fraud, allocating funds for the FBI, the U.S. attorneys, and the DOJ for the investigation and prosecution of mortgage fraud and securities and commodities fraud. All right, so that's kind of the things that we need to pay attention to. Remember that some of the things we're going to talk about on the page there, when we're going to see some later, there's bank fraud, there's wire fraud, there's mail fraud, making false statements to the government or financial institution, money laundering, and conspiracy are all federal statutes. And sometimes when there's a fraud for profit, we bring all charges against the borrower, the fraudsters. All those charges are brought against them. We don't get a lot of 30-year jail terms because guess what? When you commit mortgage fraud and when you're caught and you've got bank fraud, wire fraud, mail fraud, all these charges, people cop to please, man. You know, we get 7 years, we got 6 years on this guy, we got 10 years on this guy. We don't even prosecute. They just cop a plea and take their time because if they actually go to court, they're going to end up getting way more time. All right, so I've seen a number of those checks. So convictions can lead to penalties up to $1 million or 30 years or both. Mail fraud or wire fraud results from the simple acts of using the mail or the internet or the phone to carry out a fraud. Providing a depository institution with false information to secure funding for a loan may lead to convictions for bank fraud or making false statements to a financial institution. Money laundering, right? It can be the simple act of depositing $10,000 or more in a bank when we know that the funds came from illegal activity. So there's a fraud description here at the bottom. The IRS provide an example of a mortgage fraud scheme. IRS is going to audit certain people when there's stuff that just doesn't make sense. Like, wow, you have a lot of mortgage interest and you've got a lot of things on your, but you don't make any money. You're paying thousands of dollars a year mortgage interest and your income doesn't even support it. How did you get a mortgage of that much interest to write off in your taxes as your primary residence when this is all you make? Well, A, we're going to look into your tax returns because you're probably making more than that, and B, you probably committed fraud on your loan to get it. Or you're committing fraud or being a part of a fraud scheme. So there's two mortgage brokers. One went to jail for 17 and one for 30 months. Both falsified loan documents, and their business as mortgage brokers. The one who got 30 months had fabricated supporting documents for his borrowers, false down payments, and cut and paste. I can redo your W-2s. I got a glass desk with a light up and above, and I've got an X-Acto knife, and I've caught people cutting and pasting before. They were summarily dismissed, right? Delays on audio. Irina, are you the only one coming in and out? Nobody else has said anything. Typically, I'm notified. Reboot, call in if it's that bad, okay? Anyways, IRS, both defendants provided false information regarding their income from their business, and by mailing and transmitting false information to government, mail fraud and wire fraud. Furthermore, by transferring over $42,000 from one bank to another, that was illegal funds. We got money laundering. And guess what? They copped. They copped. All right? So what techniques do we need to look at for identifying fraud? All right? We have to pay attention to a lot of things. So review this. I'm not going to read all the bullet points here. We've got some other things I want to cover. But read through the verification of identity. read through what we look to detect false documentation, falsified appraisals, the sales contract, credit report, and finally, common sense, baby. Common sense. I had a loan application on one of our new condo projects where the borrower was under 30, making like $280,000 a year. Brought in their W-2s, brought in their pay stubs, brought in their income documentation, and as we got the rest of the documentation, their credit report back, and their assets, my assistant Jason, who's a great originator to this day, this was like in 04, 05, comes in and says, boss, take a look at this. I look at it, I look at the borrower's income, I'm like, yeah. He goes, shouldn't he have more money in the bank or put more money in the deposits into his bank if he makes $20-some thousand a month? Like, yep, he's averaging depositing around $4,000, $5,000 a month in his bank accounts. That's not normal. His credit lines on his credit cards were $2,500, $2,000. So you got a lot of money in a bank, you're making a lot of money, you're going to have a credit report that doesn't look like somebody that's making for $30,000, $40,000 a year. So we asked for more information from the borrower. They canceled their contract and went away. So looking at common sense, the age, as opposed to what they do and what they say they do, different things like that. So just really pay attention to those issues. All right, we're going to look at this page 350. Also in fraud, there's also something called flopping schemes. Flopping schemes are really popular. Or we're going to save your house from foreclosure. We're going to come in, I'll buy the house from you, I'll rent it back to you, and when we get everything fixed and your credit back in order, we'll sell it back. We'll make a little bit, but we're going to help you out. Not really. So let's take a look at this flopping scheme. You have your highlighter available, and let's look at the ECOA provisions, the federal laws they could be breaking in this scheme here on 350, 351, okay? Flopping schemes. Yes, Miss Denise, that is correct. The 20-hour safe applying mortgage knowledge to exam prep, end of class discussions. That's what we're going to need in an hour from now. So print it out on your next break or something. Good find. Was it the third attachment? What number attachment is it, Denise? If you don't mind me asking. Okay, no worries. All right. right? We get through that. There's a lot going on here. Let's start in the first paragraph. FSS solicits homeowners who are falling behind on their mortgage payments. They advertise online and in newspapers where there are high rates of foreclosure. What does that sound like? Do we have a violation there? If you're a predatory lender, they go helping people out, or are they taking advantage of people, right? What do we call that? We're going to go into an area where there are high rates of not Angela, the opposite. Not redlining, reverse redlining. We're going to go attack a high credit risk area. Reverse redlining, right? If we use the internet, we advertise online, we might have some wire fraud just to begin with. If it's fraud, we've got redlining, reverse redlining, predatory lending, and possible wire fraud. So Margaret, she wants to refinance her 5/1 ARM. It rate reset, making her payments a little more unaffordable. All right, they're now out of business with a broker, so she goes right back to the bank that's where she has a checking account. 30 days after she gets her loan application and a month after her payment, she receives an adverse action notice stating that her income was below the bank's minimum requirement. Does that sound like a violation? Probably not. But what's the outcome of the violation? You know what? We're going to not mess with people that don't make more than $4,000 a month. You got to have $4,000 a month minimum for us to mess with giving a loan, right? Doesn't sound predatory. It doesn't sound discriminatory, but does it have a disparate impact on protected classes, like, say, an older person who's retired now who doesn't make that much money? Not enough for us to mess with, but because of disparate impact rule, maybe elderly people, maybe people that are single that don't have dual incomes, we have a neutral policy that actually has a disparate impact on protected classes. Therefore, it could be a predatory or a discriminatory, not predatory, discriminatory act because of disparate impact. So the bank may have a action against them for ECOA violations based on age. They accepted the application, but they said, yeah, we turned it down. You don't make enough money for us to mess with. The bank's minimum requirement. That's the problem, Scott. Their minimum requirement. And because she's retired, she doesn't make enough money for them to mess with. That's a neutral policy that has a disparate effect on protected classes. Could be an age discrimination violation. Okay, they turned her down because she's too old and she only gets retirement income, and that's not enough income for us to mess with. We don't care about dealing with you. Disparate impact. Okay, the rest of this is what's a flopping scheme. Any problem with the guy showing up with his appraiser and his home inspector? Right? What's it called when two or more people coerce? Right? First of all, coercion. They're trying to defraud her. Well, there's three of us, and your house is worth less than it is, and it's got a whole lot wrong with it. That's because Bill says, hey, let's go rip people off. So they're all coercion to just defraud. And if they're funding these loans off a line of credit through a federal bank, they're issuing false statements to the bank with an undervalued credit. And he can't have anything to do with the appraiser, right? It's not it. They're buying it not as a primary residence, but she lives there. It's a scheme. It's a fraud. So there's some stretches here. What's going on that? So in desperation, she reported to them, and they're trying to rip her off, right? So that's kind of what's going on. They give her a low ball. They tell her all the things that are wrong. We're going to have to pay so much money to bring your house up. We're going to rip you off. And, of course, we're going to let you stay in the house. But in the fine print, 6 months from now, there's a big kicker where that rent goes to what her payment is that she can't afford. So now they're going to force her out, and then they're going to resell the house at market value. Or knowing these fraudsters, they're going to flip. It's a flip. They're going to do what we call a clean and press. They're going to make it look like the entire house has been remodeled when, in fact, the guts are rotting out. But on the surface, it looks good. So we're going to try to probably flip this house and sell it for more than it's worth to an unsuspecting borrower. That's why flips, we have to be careful. All right, so review the discussion questions, and remember, always, I love reviewing the discussion analysis of all these scenarios to help get the big picture of all the different aspects of what could be wrong or was wrong with this scenario to tie it all together. And remember, the reason I like to tell stories is they're easy to remember. So read the story and read the story problem to help reinvigorate your memory of what was going on there, okay? Great way to study. Great way to study. All right, ethics. Let's talk about ethics related to loan origination activities. There have been many changes in the market since 2008. There's a reevaluation of ethical principles in the statutory and regulatory requirements. Today's originators operating in a new market also has a regulation focused on consumer protection. They've decided that in addition to meeting regulatory requirements enforced by the Bureau, originators and companies that employ them must be familiar with consumer complaint process that's been established by the CFPB, as well as the financial, as well as how we respond to those complaints. So they work through a portal. The CFPB gave the education. So just a little bit about origination activities. Let's talk about originators. The SAFE Act says what? We got to have a 3-day class, 20 hours. We have to go and sit and take a test. Then we apply to the state who issues our licenses, your state, not the CFPB, not the NMLS, the state. And then we're going to apply to the state by filling out an MU4 form. And we have to give them our background criminal, submit to a criminal check, submit to fingerprints, and we have to tell them what our work history has been, and if we've had any criminal or other civil or any other things that have happened to us in our past. And if we have any outstanding judgments except for medical bills, if we have any outstanding tax liens or government liens, or severely bad credit, especially within the last 3 years, foreclosures, serious delinquent accounts is what they're looking for. If you have those issues, you're not fit fiscally, financially, to be in this industry, and that will excuse yourself, right? We got to have the financial responsibility, character, and general fitness as to such to command the confidence of the community. All right, so we now have those other things to worry about, right? What happened is the SAFE Act also did not. What did it say in the SAFE Act when we went over it about our ethics to our borrower? Do we have a fiduciary or an agency relationship with the borrower? It didn't say so in the federal statutes. That SAFE Act didn't address it. We'll get to that in a minute. All right. When I was talking about handling complaints, CFPB is required to establish reasonable procedures to respond to consumer complaints against providers of consumer products and services. So what they've done is got a portal, all right? So mortgage products and services. After the receipt and initial processing of a complaint, the Bureau enters the information in our database, their complaint database. All right, that takes place through a consumer portal, and they also accept complaints by fax, phone, and email. They're an equal opportunity complaint receiver. There's everything out there. To get information or file a complaint, contact the CFPB at blah, blah, blah. It's out there everywhere, bud. So people know where to complain. They know who to complain to. Different than before. All right. So then once they receive the complaints, the Bureau forwards them to the company named, and their receipt of the response is carried back through a secure system that's called the company portal. We have 15 days. We must follow the portal manual outlines, and we have to respond to that complaint within 15 days. If we don't make the 15-day deadline, we must respond in a total of 30 days in order to avoid them to making it a priority for the response team. So if you don't want to get somebody snippet in your business more than necessary, respond to the complaints right away, because some stuff I've read says that over 70% of the complaints that are made and responded to are done with at that time. It doesn't go any further because people like to complain about a lot of things. They like to complain that the process takes too long and we ask for too much stuff, and the last time they got a loan, it wasn't that hard, and the appraisal came in lower than they thought their house was worth, and interest rates went up even though they didn't lock in. They didn't like the interest rate because somebody else said it was lower. Now it's higher. Whatevs, people. That's welcome to put your big boy pants on and welcome to getting a mortgage. That's how it works. So people don't like it, so they complain. We respond, and they're like, yep, just another person who didn't like how the mortgage business takes place. It's not so easy. Not so easy, so we get complaints. Just because somebody complains doesn't mean we're doing anything wrong. All right, so it could be a valid complaint to them, but it's not valid in the scope of what the regulations and rules allow. All right, so we have to deal with things through the portal. We have to comply. All right, we have, as an employer, your company that will employ you, we must provide adequate oversight of our originator and our employees. We should have a compliance management system that says we are going to understand, and our employees understand, the policies and procedures that we're to force, that we're to follow, that we have training for employees and board members. We monitor the systems that we use to make sure we're doing things right. This is a compliance system. Compliance is so huge in today's world. They have procedures for implementing corrective actions when we find things aren't being done right, and an auditing program to look for gaps in our compliance and ensure that everything is functioning correctly. If we do that, and we have a robust compliance system in our company, the CFPB states that having an effective management system for compliance in place may help us establish a basis for claiming that a compliance failure was the result of a bona fide error. Without having all these compliance procedures in place, you don't have bona fide errors. You have lack of responsibility and lack of oversight, and you're asking for trouble. So if you have systems in place, yes, people may go outside of the systems, and we can't watch everybody at every time, but if we show we're doing what we're supposed to be doing, we should be in a much better position to defend ourselves than if we don't. All right, so without one, showing a violation occurred unintentionally could be difficult because we don't have any policies in place to make sure it doesn't happen. So the Bureau notes that violation of lending laws most commonly occur in companies that have weak compliance systems or none at all. So compliance is huge. What about our relationship with our consumers? Do we have a fiduciary duty or an agency relationship? All right. There's a debate in our industry. Some say, yes, we should work in a borrower's best interest, a fiduciary relationship. When a consumer uses a mortgage broker to find a loan, that a fiduciary or an agency relationship arises. We owe those duties, fiduciary duties, to the borrower. That includes loyalty, good faith, and an obligation to put the interest of the borrower, the principal, ahead of the agent, ourselves. We're not putting them in a loan that's better for us than it is for them. We are following their legal and lawful instructions. We are disclosing all relevant facts and costs. We are accounting for any monies that we handle for them. We are doing our best to do our best for them. That's a fiduciary duty. Back in 10 years ago, a lot of people go, rain on that. I'm looking out for me. I'm trying to make the most money that I can on this loan. If the borrower doesn't pay attention to what's a good deal or not, that's their problem. I've got a duty to myself and my company to be successful. And there's an argument. There are plenty of people that think there's nothing wrong with ripping people off, because it happened a lot, right? And what we consider ripping off here, other people consider getting a fair price for the work they put out. And somewhere in between lies what it really is. So what are our relationships with consumers? The SAFE Act, the federal law that says that covers us getting licensed and why, and the judgments and the liens and the credit report and the states, says zero about our fiduciary or agency responsibility to the borrower, not addressed on a federal level. However, depending on what state you get licensed in, you may have a fiduciary or an agency relationship with your borrower. As an example, on that page 357, California says that California Association of Mortgage Professionals says that under their professional practice that CAMP members, whether by law or professional commitment, have a fiduciary duty to their clients and strive to maintain absolute fidelity to their borrower's best interests. All right, so California, Washington, examples, fiduciary. Minnesota says a broker shall consider to have created an agency relationship with a borrower in all cases. So Illinois, Minnesota, example, you have an agency relationship. Other states, like where I live in Colorado, says we have taken this without that we have to exercise good faith and fair dealing when dealing with borrowers in lending transactions. So where do we get that responsibility? On a legal basis, not on our own method, our own moral compass, but legally from the state where we get licensed, or the states where you get licensed. A lot of people have multiple states. All right. What's your state say? We have a license in this state. What does it say? Well, in today's world, with the no steering, no dual comp, no terms of a transaction, it's hard to do the things completely wrong like we used to do. Still can be done, though. So we have to pay attention to what our relationship is, right? Truth in marketing and advertising, we've already talked about that enough. Just a reminder that the Bureau and the FTC also do conduct sweeps to address violations of advertising rule. So we always have to be attention. Most companies say you don't put anything out without going through the marketing department first. Is the ECOA and the Fair Housing sticker on there? Does it say our NMLS name and number? And is it done exactly as it needs to be to meet all TILA and state advertising rules and restrictions? Pay attention, all right? The CFPB has also been put in charge of, part of their charter says they have to create an Office of Financial Education. Boy, do we need that ever, and they should start in about 5th grade if you ask me, all right? The Bureau has to submit annual reports to Congress on what they're doing to increase the financial literacy with the activities and strategies that they're imparting. There are some websites here that the Bureau puts out that I would familiarize myself. So A, if my borrower finds it and goes there, I know what they're talking about. And B, if I like what it says, I want to be a champion for my consumer, let them know I'm working on their best interests. I want to put their interest above mine and win all my loan opportunities because I'm doing what's best for them. I may recommend that they go to some of these websites. Ask the CFPB website about owning a home, finding a housing counselor. If you're doing reverse mortgages, here's what the CFPB says about it, right? So know what's going on there. TILA has new laws. RESPA says, what do we do? Under a purchase, we give them your home loan toolkit. RESPA says, TILA says, if it's an ARM, you give them a charm. RESPA says, if it's a HELOC, you give them what you need to know when your home is on the line, what you need to know about home equity lines of credit. So know and understand those disclosures. Maybe refer to them, okay? And then our mortgage industry sometimes has a code of ethics. If you're going to be join the Mortgage Association of Mortgage Brokers or California Association of Mortgage Bankers, right? I was very active in those. I was on the board of directors for the state of Florida. I've been a local guy. Just always want to know what's going on in my industry. Plus, I've always been one to recruit and build companies. I want to meet people all over the place. So I was involved in these. And with that came certain codes of ethics to be a member of that agency. Maybe you're going to join the APMW, the Association of Professional Mortgage Women. From that, you may have standard codes of ethics, kind of what we're talking about here. We're going to conduct business with honesty and integrity, advertise only accurate information, fully disclose all the costs, charge reasonable fees, maintain confidentiality of personal information, and act in accordance with all rules and regs, right? Those are general business ethics, but we're not bound by those unless we bind ourselves to them. All right. Other people in our industry we deal with. We have to pay attention to who we're dealing with and what their ethics are. People have other ethics. Some people have different compasses than we do, and we don't want to make sure we're not working with real estate agents who completely don't match up to your values. But some of the things we need to understand is they have their own code of ethics. If you're a licensed appraisal under USPAP, Uniform Standard Appraisal Practices and Policies, or the FIREA, you have certain rules that say don't accept or an assignment contingent on bringing in a certain value. All right? Don't perform all assignments with impartiality, objectivity, and independence. That's an appraisal's ethical code. All right? Underwriters are there to make sure we are not passing bad loans and fraud loans onto the secondary market so they don't go bad, because we have a moral and ethical relationship with the investors on the backside. If we put bad loans into the system, rates will be higher, cost will be more, and we're going to have more issues. So another reason for the downfall economy. So yes, right, exactly, agreed. Thank you, Robert. Respond, an underwriter is the last line of checks and balances between origination and funding, and that loan going to the secondary market where it could cause issues. And there's just red flags here. Again, underwriting red flags. General red flags: mortgage application, credit report, employment and income, identification, and appraisal red flags. Familiarize yourself with all these things. Yes, in studying, but more so in your everyday loan originating activities, you need to be aware when something's amiss that something's amiss. How did you not catch that? Well, if you've never seen it before and you're new, all right, you're not going to catch it. But if it happens once, don't let that or something similar like that happen again. That's our responsibility. We also have responsibilities to the investor, right? Originating through underwriting and funding is called the primary mortgage market. When that loan funds, we have to now get it insured, shipped, or sold, and that's the secondary mortgage market. And we have responsibilities to the secondary market, all right? The GSEs, Fannie Freddie, and the loans that go into Ginnies are the biggest buyers and insurers of mortgages in the world, much less the U.S., and we have responsibilities to them. All right? 10-minute break. Make sure you get your end of class discussion review, 15 questions printed out. We're going to spend 10 minutes finishing up ethics. We're going to go to our ethics quiz, and then we'll be doing our final discussion scenario in our last hour. Of course, some of you are coming back for the UST, but this is the last of the 20 hours. 10-minute break. See you back in 10. All right, we're back. All right, good question here. Got a question. It says, if credit union or bank MLOs are not required to be licensed, what ensures that there's adequate oversight of the employees' duties? That is the job of the bank or the credit union. She said she was at a place where there was no supervision of the mortgage lending department. One of the reasons why they're leaving. Well, that's just an individual spot where you were. I just did this 3-day class for a private class of 4 in the San Diego area this last week, and they're all leaving the bank. And they have compliance tests and oversight. I mean, it was like, wow, right, there's the reason why they don't have to do the CE and the licensing like we do, because their bank is so over the top in making sure all that stuff happens. So where you're leaving or left is, from what I've seen, an exception to the rule of what depository institutions do. The smaller ones may be a little more haphazard, but this was a large bank, and they do a lot. All right, so that's a good question, but that's my take on that. So we're talking about our relationship with investors. All right, the secondary market, we talked about where it's come from. But the thing is private investment banks participate in the second market, but GSEs, Fannie, Freddie, and Ginnie, are the major buyers of loans. All right, but we've got to pay attention now. We've got a new federal oversight agencies of Fannie and Freddie. Some things that happen is that in 2008, Fannie and Freddie lost a combined $3.1 billion between April and June. That's over $1 billion a month. Over half of their credit losses were from these type of risky loans. What they did is they started buying subprime loans. Or Wall Street, if you watch Newsroom, when Olivia Munn, then they took all these bad loans and put them in pools with good loans and sold them to Fannie and Freddie. And Fannie and Freddie's like, okay, these subprimes, they pay more. And they all collapsed, which government-owned or government-sponsored, held up by the government, major issues. So next paragraph. Under HERA, the oversight of Fannie and Freddie from HUD and their Federal Housing Enterprise Office to highlight the Federal Housing Finance Agency, the FHFA. So the Federal Housing Finance Agency has much more involvement with Fannie and Freddie than the former HUD regulatory agency does. So they really oversee. They are absolutely at this time too big to fail. There's a lot of stuff been talked about over the last years about eliminating Fannie and Freddie and going completely private, making Fannie and Freddie completely not a government-sponsored enterprise, but a government enterprise. You've got one side versus the other. No, do it this way, big government. Figure out which side that is. No, make it completely private. Somewhere in the middle probably is the best solution, but that's where we're at right now. We also have responsibilities with who we fund our loans through. If we're a warehouse lender, a loan that's some people call it table funding. That's what a broker can be called too. One of those terms that can be used for more than one thing. But if I'm a mortgage lender, we're called a warehouse lender, right? Or a table funding lender. We fund loans off a line of credit or a warehouse line with a bank. We had a $200 million warehouse line, which meant we're trying to close about $500 million a month. That's about 2.5 times. You fund loans, you sell them, get them off. You fund loans, you sell them, get them off. And that's where we turn our money. We fund our own loans off of a warehouse line or line of credit, and then we sell it to Fannie or Freddie or to whomever we're selling loans to. All right, and the servicing we keep, or we service release as well, different aspects. And that's created a lot of flexibility and agility in our mortgage industry. But when we're using and we're dealing with our lenders that are our warehouse lenders, if we put bad loans on there, if we commit fraud and they have to buy them back, which you always have to buy fraud back if a loan defaults and they find fraud, you're buying it back. If they do a QA, they find fraud, you're buying it back. And a lot of that can have devastating consequences depending on how big they are and how many buybacks or challenges they get. So if there's any unethical conduct or fraud related to a particular loan, the originating entity may be responsible to buy the loan back. So we have a responsibility to make sure we're only putting good loans through the system. Remember, it never does a borrower any good to commit them to a loan that they can't afford. That's another aspect of ATR. We didn't do these investors and all the people that got all the subprime and stated income loans that they should have never got. Most of them lost them in foreclosure. It didn't do them any good at the end of the day. It didn't do anybody any good to put people in loans that they can't afford, etc. So that's our responsibility. We also deal with a lot of real estate agents or sales agents from builders and things like that, and they refer. We got a lot of referring partners. If you want to be really good in the industry, you're probably going to want to try to do a lot of purchase business as well as a mix of other type of business. But if you're getting referrals from real estate agents, you're getting referrals from sales agents, we have to watch the fine line between what we tell them and what's protected information that we can't tell them. I've been asked to provide bank statements on every borrower that I have in a pipeline for a certain real estate agent. No, I can't provide you. I can give you a commitment letter that they've been approved and we've verified enough assets to close the transaction, but I'm not going to give you a copy of their bank statement. I can tell you that their credit score is a little short of what we were trying to accomplish, and we need to get them to get a higher credit score or switch them to another loan product, but I can't tell them that you guys are the worst credit borrowers and I've got a 515 credit score, right? So understand confidentiality with them needing to know what's going on their transaction that they're involved with. All right, privacy is an area of concern, so we could share a little. We just can't share specifics or a lot, and you may be asked to do that, so you know what your responsibilities are to your borrower as well as to the realtor that's working with that borrower or representing the seller possibly. I can give you some information about how good it is and that it's approvable, and I've got a commitment ready to go, and the appraisal's coming back, but I can't tell you got $347,000 in the bank and you make $500,000 a year. And when you do loans for celebrities or high profile, people always ask those questions. Well, yeah, that's the whole point, John. That is okay. Yes, discussing pre-approvals, the realtor asked you to get them pre-approval. Yes, they're approved. We have a good enough credit score. We have enough income. We have enough assets. That's general. Not they make $317,000 a year, not they have this much money in the bank. That's not. Now, that's fine. Either one. No specifics, generalities. Yep, our credit score doesn't quite meet the criteria we're looking for. I don't think that's a problem. They're not mortgage ready either way. What makes them not mortgage ready? Well, their credit's not quite where it needs to be at this time. That's okay. All right? And processors, our responsibility. Federal and state licensing laws have a distinction between originators who offer and negotiate loans and processors who we use the term perform clerical and support. A borrower can give anything to the real estate agent they want. We are not in a position to give that information from our borrower to the real estate agent. Okay, that makes sense, Reggie? The borrower can say, I go pound sand. I don't need to fill out a financial statement for you. I'll give that to my lender. None of your business. And it's not. But if they want to, they can. They can ask for anything. A realtor can ask for anything. It's not our place to give it. The borrower has to decide, do I want to give them my bank statement? No. All right? So what a processor can do, they can talk with consumers, gather information, tell them the title's in, the appraiser's going out, we got this back, we need the BOE, we hope to close next Thursday at 1:47 p.m. What they can't talk about is, hey, Betty, do you think that 3-year arm or that 5-year arm is the better deal for me? You know what? I'm not a licensed originator. I can't discuss the aspects of your exact loan or the interest rates or fees associated, right? So the whole loan, structuring a loan, giving advice on a loan, or talking rates, terms, and fees, not allowed to do if they're not licensed, all right? They're also prohibited from representing that they can do any of those duties if they're not licensed. A little caveat to that is, state of Kentucky, they have to be licensed. What else was I going to say? Oh, if a processor or even an underwriter doesn't want to be an employee of a company anymore, they want to be subcontractors or just work for themselves and process and underwrite, they would have to have a license to be a subcontractor and go out and offer their underwriting services or their processing services on a subcontract basis. All right. Third-party providers, this is the part that I just can't believe that the CFPB says its expectations regarding the steps that banks and non-bank lenders should take for managing the risk of service provider relationship. They should include that we conduct the due diligence to determine whether the provider understands the laws and determine if they're capable of compliance. We should review their policies, procedures, and employee training to make sure they understand their capabilities to comply with the GLB, for instance. We should only enter into contracts that has enforceable consequences if they violate those responsibilities. We should monitor and create a program to determine if they stay in compliance with the law. And we should always take prompt action to fully address any problems identified when we monitor their process. Absolutely, in my mind, insane that this is a mortgage lender's responsibility to babysit third-party providers. If you're an accredited company who is a RESPA provider, which means you're a legitimate company, they should be able to have their own responsibility for their own actions, but they don't. This is our, says so right there, our. And the last thing we're going to worry about, this is here's a file, getting ready to submit it. The employer's address is a PO box. There's inconsistencies on their pay stubs and payroll dates. There's different addresses on the applicant's identification documents. Some of them might not be on the application. And the social security number begins with a 000. Does anybody think there's any problem significant to indicate fraud here? Right? Well, first of all, there are no social security numbers that begin with 000 or 8s or 9s. And besides everything, right, Eugene? Right. Other than everything, does anything here think there could be fraud? The PO box just depends on where they are. Other than that, everything else. All right. Consumers, besides the fact that we took away liar loans, do you think that has stopped consumers from trying to lie or make fraud to lenders? Of course not. As a realtor would say, how can you tell when your buyer is lying? It's because their lips are moving, right? Buyers are liars. That's what the realtors say, right? There are a lot of looky-loos. I want to go look at $800,000 houses. They qualify for $200,000 or nothing. They just want to waste their time or tell them that this and this and that. They get a lot of runaround, all right? That's why we get our realtors to refer us to your clients before you drive them all around town. If not, and they're not willing to discuss something with a lender that you have a relationship with, you may want to reassess the fact that you want to drive them all over time and waste time until you know more about it. On occupancy issues, we get a lot of fraud with occupancy. So let me get this straight, Mr. Borrower. You have a house that's worth $500,000 5 minutes from your office, and you're buying a $200,000 fixer-upper on the other side of town with a nasty 45-minute, if you're lucky, commute. Really? And you're going to live in that house as your primary residence. I don't know an underwriter around that's going to go, oh yeah, that makes sense to me. We're going to question. All right, so we got to pay attention to those. And we don't have lax lending standards anymore. So we got to do our own due dil, and that's our job, it's our processor's job, and it's our underwriter job to make sure we're catching all that stuff. All right, so the last scenario is talk about red flags. There's different red flags. Take a look at that just to give an idea of what red flags are or aren't there, because I want to move on into our ethics test. Everybody find their 25-question end-of-class discussion, but first we're doing our ethics test like we've done every other, all right? So, Alec, would you put out when I call out the question numbers, would you put those out there for me, please, sir? The first page we're going to do is 1, 3, 4, 7, and 8. 1, 3, 4, 7, and 8. Thank you. What was I doing here? Oh, timer. Nope, that's an alarm. Oh, timer. Burn my tongue on coffee this morning. And I'm going to launch the last poll. Do you think the industry should have more oversight, or should we be left alone to police ourselves? My answer to that is, how'd that work out? I like it. So far, 0% only industry policing. We kind of tried that. Not so much worked out so well. Right, number 2. All right, thanks. I'm going to close that down. Thanks for sharing. Close 30, 19, 40, and 12. All right. Number 1. Which reason would be permissible to refuse an application from a borrower? And the first one is B. They're submitting false documents. They're false documents being submitted. No bueno. Fraud, right? Fraud. 3, a hazard insurance company hosts a dinner for the employees of a broker. The broker says, guys, use this guy for all of our insurance. Isn't he great? Thanks for dinner, by the way, buddy. Who's in violation? T, was there a thing of value? Buying dinner and drinks for everybody. That's a thing of value. Oh, was it offered? Yep. Did they accept? Yep. Did they do any work to earn it? Nope. The answer is C. Both of them. Both of them. All right. If some of you said B, the mortgage broker, but they accepted. They went to dinner. They had the drinks, and it was strictly to do what? Say, come on, man, use us. Use this guy. Number 4. A broker is unable to assist a client, and he refers him to another broker. The second broker pays a referral fee for the lead, which is correct. Based on the information we have, D, it's illegal. My theory on this is, did the first broker take an application? Did he gather documentation? Did he discuss loans and try to make something work? That would constitute work, W, which means that fee would be legal if there was work done. But they didn't say it wasn't, so you D people out there, which looks to be all of you, right answer in the scenario given. Number 7, it's unethical and illegal for yield spread premium to be used anything other than to, and I hope we all have heard this 17 times, that yes, C, borrower credit. We're going to pay, Kristen, they're going to pay for the borrower's costs. C, I mean, good catch. And number 8, the GLB protects the privacy of the non-public information using all of the following except. Which one of this is not part of the GLB? Ooh, yeah, sometimes I get some mixed answers here, but so far so good. A. A. They don't ask permission. We tell them what we share, and we give them an opt-out. That's not asking permission. If they don't opt out, we do it. So the rest of them, B, C, and D, are all part of the GLB. A. Hundreds? Killing it? Ethics are great? All right. Next page, 11, 12, 16, 18, 20. 11, 12, 16, 18, 20. All right, number 8. Number 11. Which of the following statements would be permissible dealing with an appraiser? CADCD? That's just a lot of answers for one. And the answer is C. Compared to the comps, I think you're a little low. Can we look at some new comps, please? C. C. Number 12. For a fee, the real estate agent says, here's all the names and numbers of the people came to my open house. The mortgage company goes, what a waste of money that would be. All the neighbors and looky-loos? Sure. No way. And the answer is yes. A, the real estate licensee. They want something for nothing. Number 16. Was it 16? 16. A real estate company gets flyers from a mortgage company and puts them at the open house. Violation of RESPA, or is that promotional materials? Flyers. That is not a thing of value. D. Not a thing of value. 18. Mike's a small business owner and he says, how much money do I need to make to qualify for this loan? What's your best answer? Why don't you give me all your income and assets and let's see what we can do to get you qualified. Let's see what you make. C. Let's review what you have. C. 20. Which of the following compensation practice is allowed under the new comp rule? And I'm going to go start originating tomorrow if I can D. Get paid 3% commission on every loan. 3%, first of all, it's going to not be a QM, right? D, same percentage on all loans. Yay! Heck yeah! People are getting smart today, right? Who feels a lot better than we did 48 hours ago right before lunch on Monday, right? Newbies, right? I told you, just breathe, baby. Just breathe through it. It's going to get better. Now, your work's not done, but we're going to get better, right? Awesome. All right, 23, 24, 27, 28, 32. 82.68% better. I like it. I took the poll question down a while ago. Eric. Well, good. You just got your book in the mail. You had the PDF file. Now you can go back and book through to study through. What's showing? The poll question is showing or no? No. Oh, I don't know. Oh, we already did it. There. That better? As long as that helps you get your license, I'm happy to change slides. There's only 15 questions, and it's an attachment, just like you found your other questions, Reggie. It's another attachment in that same email. It's like the next attachment. It's called the 20-hour safe comprehensive applying mortgage to knowledge exam prep, end of class discussion reviews. Everything you need is on the same email, all attached there. Okay. All right. Number 23. Which of the following broker policies would violate fair lending laws? Cool. Right? Saying I don't close loans in that zip code, that's redlining. D is redlining. 24. Basing a loan approval on the value of the property's collateral and not considering repayment is an ethical violation. What do we call that? It's now illegal to D, have equity-based lending. D. All right, if you're in a state that has an agency requirement, which of the following practices would violate your duty to serve as their fiduciary? It's kind of not, we're getting it right. It is D. It is D. That failing to submit an FHA loan at the borrower request following their legal lawful instructions. Somebody said B. Anyways, right? But somebody said B, advising a borrower wants an FHA loan that they should apply for conventional. In most cases, a conventional loan is going to be cheaper, less mortgage insurance, and better. So borrowers may think they want an FHA loan. It's like, I think I can get you approved for a conventional loan. It's going to be a better loan. It's going to be less PMI can come off, MIP doesn't. If it's in their best interest, that would be what you're supposed to do. All right, but failing to follow their legal lawful instructions is also a violation. So that's the difference between that. 28. 32? Wait, is that the last one? Yeah, 32, sorry. Which of the following statements offers the most accurate description of a trigger term? No. 28? Oh, sorry. All right. All right, time out. Time out. 20, all right, we'll do 32 because we just did that. And most of you, let's do, sorry guys, if I say 32, let's do 32. I can always back up. 32, use of a trigger term. It does not violate Reg Z. It does not violate Reg Z. When there's a trigger term in the ad, it triggers the need for more information about that term, clear and conspicuous. C. You need to tell more information about that term, clear, close, and conspicuous. The payment of $1,000 a month is a trigger term. It's not illegal to advertise you can get a payment for $1,000 a month, but it triggers the need that you need to say how many months and what's the APR would be the clear, close, conspicuous disclosure of the trigger term. 32, C. A lot of people get this wrong. All right. It doesn't need full disclosure of every aspect of the lending. It's not a violation of Reg Z. It's only a violation of a Reg Z if you use a trigger term and you don't come back with the information that the trigger term needs to be untriggered with. All right, so back to 28. A broker is required to provide an opt-out notice, in which case? 28. And that's right. C, when we do share non-public personal information with non-affiliated third parties, then we have to tell them what we share and give them the what? Reasonable opportunity to opt out. And then 32 was C. Thanks, guys. All right? How'd we do there? Next one. 33, 35, 37, 38, 39. 33, 35, 7, 8, 9. 33, according to federal fair lending laws, which of the following cannot be considered when qualifying an applicant? If you're dealing with somebody who is pregnant, you cannot ask, hey lady, what are you going to do after the baby comes? If she's on their job when we do the loan and when we fund the loan, she's on the job. A, can't ask childbearing or child rearing questions. 35, Cindy's an originator. The appraiser says, I'll give you any appraisal you need. All you have to do is let me know how much you want, the valuation, what should Cindy do? Right? She should see, report the actions of the appraiser, and say, no, thank you, I will use someone else. Yes, says Maziel. Yes. 37, in which of the following cases would it be permissible to withhold compensation from an appraiser? And that again is C, when the appraiser provides valuations with inappropriate comps, errors, and generally malaise, inaccuracy. 38, Michael bought a luxury home. IRS says, how can you afford such a big house on such a small income? You report to us, and in the middle of it, they find what? Mortgage fraud. What may they do? And yes, the IRS, HUD, and the FBI can all share information so they could A, refer Michael's loan to law enforcement for mortgage fraud. So when he did the fraud in 39, him and the broker kind of talked about it. How much should I state? Well, if you say 10,000, that'll probably be good enough. Okay, fine, I'll do more. Which statement most accurately describes liability? And the answer is yes, B. Both the broker and Michael are liable for submitting false information. Fraud. 39. All right, we've got time. Let's do one more stanza here. One more. You're killing it, huh? I appreciate. Awesome. Your instructor was on it, Mr. Alvarez. 5, 6, 14, 29, and 34. Just kidding. 5, 6, 14, 29, 34. Let's do 5 more before we move on. All right, This is a good one. Even before the adoption of Dodd-Frank and ATR, which federal law required verification and documentation of repayment ability? Which was the first one to do that? I see a bunch of right answers. I see a couple wrong answers. C, HOPA. High-cost loans were the first one to say no more equity-based lending, especially on these predatory loans. You can't set people up to lose their homes. HOPA eliminated equity-based lending and instituted ATR well before ATR became a thing under TILA. HOPA, C. Oh, yeah. Most of you got it right. 6. Advertising an attractive rate that we actually don't have is a violation of, and that is not telling the truth about advertising. And that is it. Reg Z, A, no telling the truth. TILA's car, cost and terms of credit, advertising rescission, tells the truth, right? 14, a title insurance company gives a computer to mortgage broker. The broker uses the computer to transmit documents to the title company. Violation? Yes, both. I gave them a computer, thing of value, they accepted the computer. They can use their own computer. That's a violation on both of their parts. C. 29. If you were to take on the role of a borrower's agent, you are also said to have, that's it, fiduciary duty. Fiduciary duty. And number 34. An ad says refinance and we can save you $300 a month. Oh yeah, nobody slipped up so far. All right, and that answer is B. Not a violation of TILA if it provides information on APRs and payments with equal prominence as long as it's true. That's a great, I like to end with that one because I want to talk about you're getting your exam and everything, right? Schedule your exam through the NMLS website. But one thing I want you guys to do is always remember to read the question carefully. A lot of times it says and, except, you know, we're looking for the wrong answer. You know, it says all of the following are true, but. Well, then if you ever remember Sesame Street, one of these things, Sesame Street, one of these things just doesn't belong here. If it's a everything is true except or but, one of those things just doesn't belong, right? We're going to look for the wrong answer, right? And a lot of times it gives you a whole bunch of information that you don't even need to have. Got a 5 1/4 rate on a 30-year loan, you know, what's their LTV? It doesn't have anything to do with the 5 1/4 rate on 30 years. So always, if there's a lot of information you're looked at, just back up. I like to say tap the brakes, reread the question, and think, okay, what are they asking here? What are we asking here? Cut through all the mumble jumble that might be in there and determine what are they asking. And that question 34, you know what? If you advertise refinance now and we can save you $300 a month, it is a violation of TILA. All right, so if you read A and go, yep, you can't say that, and you circled A, you just got a right answer that's wrong because it's not the best right answer. You got to read all the answers. There's going to be an answer such as A, and nobody typed in A, and normally there's an A there because it is a violation of TILA unless what B says. And that's the best answer. All right, so, you know, another thing I like to do is sometimes we just don't know, and we just guess. Well, before you guess out of 4 questions, there's usually 1 or 2 of those answers that are pretty obvious isn't the right answer. Make sure you eliminate a couple answers, you know. Play Who Wants to Be a Millionaire. Go 50-50. Try to get it down. Well, I don't think it's definitely not A. So guess from some people just get frustrated and say, I don't know, C. And C is like, no way ever is it C. And if you really thought about it, it's not C. Something else I want to point out is if you turn your page in your book, after ethics, there is a safe mortgage originator test content outline. All right? It does say changes have happened. We are I don't think there's any changes we're not up to date with, right? But it shows you that 1, federal mortgage law is 23% of your test. 23% of the 125 questions will be from federal mortgage law. RESPA, ECOA, TILA, HOPA, HPMLs, loan originator comp, right? Little outline of the major areas that we cover. right? And if you're going through that and it's like, oh, I don't remember anything about the bank secrecy and anti-money laundering, all right, well, that's the Patriot Act, and you might want to go reread that. So it's a good thing just to say, all right, I remember that. Ooh, I don't remember that. Well, go read it. If you're coming across something in the book that you don't remember us talking about, read it. I don't read the book. I can't read the book. There's information in there that we don't talk about, and it may or may not be on the test, but if it's in the book and you haven't heard it, review it. All right, so federal mortgage law, 23%, general mortgage knowledge, 23%, origination activities, 25%, ethics, 16%, and the UST, uniform state content, 13%. Some of you, when we're done here in 15 minutes, are going to be going to an hour lunch break and coming back to join me for our 2-hour UST prep course. It's not mandated by the SAFE Act that you take any more courses than this 20-hour. So it is up to you. But 13% of your test comes from the UST, which means most states don't offer their own state test anymore. In fact, California just stopped, and they were the ones that did. They're part of the UST now. We all have to take the UST. It's part of the national course. If you didn't sign up for that, you're not aware of it, you want to find out how much it costs, or if you can get in the class today or next week, contact customer service. I don't have that information, but it does give us 13% more information that's going to be on the test. Then after that, there's a glossary. All right, the glossary is, besides the financial terms and the other terms that were in the loan general mortgage knowledge yesterday, this glossary is great for anything that comes up in the mortgage or real estate field. If you don't know what it is, find it. It'll define it for you, okay? Just a great tool for your studies and for your endeavor back into the mortgage business, especially for my newbies, okay? That's what I got there. So now we're going to take our 25-question end of class discussion review. And what we do here is some of you haven't been typing in your answers, and that's fine. I like to monitor how the class is doing. I had enough participation to see that we're doing pretty darn well. But now, if you want to pass this course and get credit for it, you have to participate. So when I ask a question, we read a question, we're all going to answer it. I may call somebody out specifically, because I'm supposed to, and I'll ask somebody a question. Right? I might ask somebody a question that says, okay, can you explain why, or what was your reasoning behind that? Okay, and this is what we have to do to have our end of class discussion review. So ready? Let's start number one with everyone. What's the primary purpose of the Truth in Lending Act? The primary purpose of TILA, all right, I'm going to wait and make sure everybody gets their answers in. All you have to do is answer. We just have to see participation in the discussion, all right? And the answer is C, clear disclosures on the terms or cost of credit. Really, people were waiting for me to answer? Show some chutzpah. Answer a question, would you? There's only 15. I said 15. Somebody else said 25, Todd. I said there's only 15. No, we're good. Number two, Homeowners Protection Act says with lenders can cancel PMI when their loan is less than, or we can collect it until, right? There's two numbers. They can request it at, and it comes off at. I see a few C's on here. Where did we ever talk about 65%? All right, the answer is D. The borrower can request it at 80 and the lender can take it off. The lender has to take it off at 78%, right? We don't have PMI when the loan's 80%. When we get PMI, we cover it to 78%. So that's where the 80 request, 78, you would never want it at 80, so the borrower can request it. You only get it to 78 when you get it, so when it's paid down to 78, you should take it off. If what? They have a good payment history, they're current on their payment, their house isn't worth less than what it was worth when we did the loan. All right, I'm going to go with, hold on. I'm going to go with April. April, your name's in front of me there. Number 4, which of the following? Nope, which of the following is included? Number 3, when calculating a finance charge. Which one of these is a finance charge? That's right. It is B, interest. As I say, the interest is the mother of all finance charges. Definitely a cash buyer would never pay interest. All right, number 4. Which one of these is an open-ended line credit? Open-ended. Repeat transactions. It's not closed when we give it to you. And of course, a HELOC stands for C, home equity line of credit. HELOC. All right. Let's go with, all right, Azil, you're on fire today. Azil, number 5. MIP would be used for which of the following? All you Azils, go ahead and answer. I called on him, so I can't see his answer. If I mention when I call out a person, I see you, he says, right? MIP goes on every FHA loan, up front and annualized paid monthly. No matter what the loan to value is, FHA has MIP. All right, you would never put MIP on a conventional loan. It's not A because conventional loan has private PMI mortgage insurance. It is an attachment to the email that we've used all week to get into the course. One of the attachments was the 4 tests that we've been taking all week. Another attachment at the bottom is end of class discussion review. That's where this and everybody has got it from. The one email that we've used all week for attachments and to log into the class, okay? That's the only one we have, or that I worry about. Sorry. Number 6, what would we give a borrower that would detail every principal and interest payment on a loan? Here's a 30-year loan. Here's a 30-year loan. Here's how much goes to principal. Here much goes to interest. How's your balance? Next month, you're up, right? A is for amortization schedule. A. Some of those are just, let's just hold off till I answer the question, please, so I can see the questions that we're answering. Because now I got new letters coming up, and I'm like, whoa, you people are that, oh, next question. So please wait, and let's just do it as we, all right, Brianna, Miss Phillips. A bar asks you, what's a point? What's the best definition here for a point, Brianna, or everybody else? There we go, Brianna. D. A point is 1% of the loan amount. 1% of the loan amount. All right, everybody. 8. Which is the following best describes what's the LTV? What is the LTV ratio? And it is the percentage or ratio, B, of the borrower's principal loan balance, their principal loan, compared to the appraised value. You owe 78% on your mortgage compared to what your house is worth, your loan to value. Awesome. All right. He, lim. Number 9. What do you think is the best definition of a trigger term? Of course, guys, wait till I ask you to answer. He says it's C. Everybody agree that trigger terms, when are in an ad, require the clear and conspicuous disclosure of other relevant terms? Yes. C. A couple of people, I just saw wrong answers. I just emphatically went over that question 10 minutes ago. A trigger term is not illegal. It doesn't violate Red Z. It doesn't require all HUD-approved counselors. It doesn't require lending terms of the mortgage in the ad. It is specific information about itself. 4% interest. That triggers how long and what's the APR. It triggers the need for more information, and that information needs to be stated clear and conspicuous. No fine print on the next page or at the bottom of the page. Same size font, next, and I use the word close, clear, close, and conspicuous. We have to define what that trigger term is made up of. Trigger term needs you to trigger more information about itself, all right? If you miss that again, I want you to read it 14 times, slowly, forwards, and backwards, all right? Trigger term. All right, number 10. Which of the following would be a thing of value and a violation of RESPA? Let's That's right, it is. A loan originator gives a travel voucher to an attorney for introducing a company. If you know any attorneys, especially divorce attorneys, don't give them travel vouchers, but befriend them and let them know how you would love to help their divorcing clients refinance or purchase homes after the divorce. Great source of leads for me. I had two that I played golf with. I didn't like playing golf with one of them, so I'd always see him at the club. Hey, buddy, how you doing? Let me not buy you a drink, because that'd be a violation of RESPA if I bought that realtor a drink, or that attorney a drink. Now, if I bought him a drink because I lost a golf bet, maybe okay, right? 11. What do we do with yield spread premiums today? It is illegal and unethical to do anything other than, please, oh please don't anybody miss this. I think it came up 43 times, right? C, we can use it to pay our borrowers' costs. They have elected to take a higher interest rate to eliminate cash. I can give you a 1/4% higher rate, and it's going to save you $4,000 in cash. Higher rate, $4,000 in cash. Heck yeah, it's an option that a lot of people love, especially people that are a little short on cash, first-time buyers, scraping it together. Well, rates are so low, we can give you slightly higher rates, can get you a $47 higher payment, but it's going to save you thousands of dollars in cash today. Boom, that make a deal happen. Perfect. All right. This is a fill in the blank, right? 5 siblings own a house and they're subject to refinance. That means somebody lives in it. The transaction has rescission. If they want to rescind, how many have to rescind? To void. To void it. Ooh, no, I saw all of them. No, 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 no. How many get 2 copies of the rescission notice? They all get 2 copies of the rescission notice. Only one of them, 12, only one of them has to rescind. So don't confuse. Yes, all 5 have to get 2 copies of the rescission notice. Otherwise, they get a 3-year rescission. But the husband and wife that live in the house don't even have to realize that their uncle, whose name's on title, can say, yeah, I don't want that to happen. I'm going to rescind the transaction. Only one of them. Only one of them. I saw just a couple wrong answers fly by. C and B is a small creditor. They originate loans and hold them in their portfolio. They only want to do QMs. They do assess repayment ability, but they do not consider debt to income ratio. Would that be compliant with the law? All right. I saw a number of different answers in there. They go by consider. If you're a small creditor that holds the loans in your own portfolio for 3 years, what are the exceptions that you get? There we go. Rachel. Rachel's my answer girl. Rachel, yes, small creditors do not have to comply with the 43 rule so long as they hold the debts for, she said 5, it's 3 years. The balloon is for 5. If they're holding it in their own portfolio, they have to do a ratio, but the 43 limit does not apply. Why? Because they have accountability. If that loan goes bad in the first few years, typically if a borrower can't afford a loan, it's going to be within 3 years. They're on the hook for it because it's their loan in their portfolio and they're servicing it. So they can do any ratio they're comfortable with because they're holding. All right? And what else can they do? Can you please wait to answer the next question until we get to it, please? Okay? What else can they do? Balloon payments. Balloon has to be 5 on a 30-year term, 5-year balloon minimum if they hold it for 3 years. That's our 2 main exemptions for small creditors. Starting in March of 2016, only small creditors that serve rural or underserved areas get to make that balloon. I like to touch on that again because it's one of those little odd things that feels like it could be a gotcha. Okay? So that is yes. 14, originators completing a loan application of a borrower. The borrower does not wish to give us that information. What should you do? What should you do? Right? First of all, what is it? Based on observation, best guess, and what are we talking about? It's about HMDA, it's about race, it's about gender, it's about ethnicity, and we make a visual assessment based on visual and or surname of what we think they are if they refuse to complete it. HMDA. And here's the realtor wanting to sell us leads from the open house. And we going, yeah, no, thank you. Who's in violation in this scenario? Right? Did we offer to pay? We didn't offer to pay. She offered to sell leads, referrals. And we said, what a waste of money that would be. No, thank you. The realtor is in violation. That, my friends, is our 20-hour course. Some of you will be back in an hour. I'll see you there. I am doing the UST today. The rest of you that are not coming back, we will send you a confirmation email to all of you that you have completed the 20-hour. You can go schedule your test. Do it sooner than later, especially if you're not a newbie. Get it scheduled later in the week. I would do it right away, right? You will have received another email if you're part of the USC. You don't know if you're supposed to come back, contact customer service. All right? For those of you that are not coming back for the UST prep course, I thank you for being with us. I'm Scott Genzer, and I hope I made these 3 days a whole lot less miserable than you thought they were going to be. All right? There's going to be a survey pop up today. Please take 2 minutes and complete the survey. All right? Thank you, Alicia. Thank you all. Reggie, yeah, you guys can notify me at scott.genzer@gmail. I'd love to hear from you if you want to answer, tell me that you passed the test with the 94%. All right? I do the CEs every year. I don't do as many of those as I do the pre-licensing course, but I'm out there. Guys, have a great day. We'll see you in an hour. If not, best of luck to you. Have a great career or extension of your career. See you in an hour. All right, Angela. See you then.